Happy evening to one and all present here. Welcome to today's session on back to basic education series on income tax. We have with us CA ABHINAYA M A, who will take us through income from salary, income from house property, section 15 to 17 and section 22 to 27. May I request Abhinaya to come and over the aspects. Please give her a bit of a round of applause. We will start with today's proceedings with the invitation of the same person. That is always priceless. State rank in class 10, special award from the then Tamil Nadu Chief Minister, late Mr. J. Jayalalitha for securing state rank. She is a budding star. She has got 3 years of auditorship experience at Surya Guru Chartered Accountant, 2.5 years post-qualification experience as a tax associate at PwC, specializing in corporate and international tax. 1.5 years of experience as manager, tax and regulatory at Mrs. V. Narayanan and Company, Chartered Accountant, Chennai. She is presently the senior associate at PwC, specializing in corporate and international tax. She has taken sessions on tax topics organized by SIRC, IC Women's Empowerment Committee, CA Study Circles, etc. She is initiating and conducting knowledge management sessions, debating on various tax topics at PwC and Mrs. V. Narayanan and Company. She has been performing Carnatic music, vocal concert and awarded All India. So I have a great pleasure in presenting before you Abhinaya to take us through income from salary and income from Since being a Carnatic music vocal concert, may be requested to start the session with an introduction. Good.
Vinayakam Sri Vinayakam Vinayakam Sri Vinayakam Vinashakam Vandeham Satatam Vinayakam Sri Vinayakam विनायकं विघ्नविनाशकं वन्देऽहं सततं विनायकं विनायकम् गणनायकं गणनायकं विघ्नकरुणासागरं गणनायकं विघ्नकरुणासागरं कमनीयालङ्कारसुन्दररूपं गणनायकं विघ्नकरुणासागरं कमनीयालङ्कारसुन्दररूपं विनायकं विनायकं पाशाङ्कुशधरं परमपवित्रं पादारविन्दं वन्दितफलदं शङ्करी शङ्कर प्रियदनयं शङ्करी शङ्कर प्रियदनयं शरवणभवगुह षण्मुखसोदरं शङ्करी शङ्कर प्रियदनयं शरवणभवगुह षण्मुखसोदरं मूषिकवागणमोदकप्रियं मुनिजनदेवादिपूजितचरणं विद्यासमस्तकलानायकं विमलानन्दमङ्गलहृदयं विनायकं सिद्धिविनायकं विघ्नविनाशकं वन्देऽहं सततं विनायकं सिद्धिविनायकम्
Our request. In fact, that was a very soulful tradition. May I now request CAKD Sudhakar sir to come forward and present a memento on behalf of SIRC as a token of our love and affection. Thank you, sir. Over to Abhinay. If you want color, you can use that. This one.
Namaste. A very happy evening to all my fellow chartered accountants gathered here. Firstly, it's an immense pleasure to be here as a part of a very wonderful series which is initiated by our SIRC or ICAI in the name Back to Basic Educational Series on Income Tax. And I would like to definitely thank wholeheartedly our institute for having given me this wonderful opportunity. So the topic that is allocated for today are two heads of income, which is salaries and income from house property. So as you all would know, these two heads of income are, they have such a significance that everyone, say each one of you who are present here may be at different roles. Say for example, one person might be a consultant, one person might be taking a role of, say, in a corporate, who might be handling employee taxation, or one person, like every one of us is a taxpayer of course. So each of us have different roles, but the one thing that is common, that is commonly seen in each of these scenarios are these two heads of income. Say some people might have PGBT or some people might have capital gains, but everyone will have salary or income from house property. So this is something which is common and which is very significant on materialistic from a professional standpoint. So therefore, these two heads of income, though it might look like just a 3 plus 7 sections or say a 10 section chapter, it has that much intricacies and nuances as income tax will have forever. So there are that much surprises and intricacies that we could learn at every moment that we learn, that we read through the same section. So likewise, today's agenda will be to have a refreshing, to just have a mind refresher on the provisions of Income Tax Act from the chapter salary and income from house property, and at the same time have some interesting case studies from the recent jurisprudences so that we are aware of the changing litigation landscape. So that will be the objective of today's session. So with this we'll move on. So the first half of the session will be on salaries and the second half of the session will be on income from house property. So as we know, salaries will comprise of 3 sections, section 15, 16 and 17. Income from house property, it starts from section 22 and it ends with section 27. We will go through each and every section and we will read through intricacies to the extent possible, because it's like it's an ocean, so we cannot cover everything, but at the same time to the maximum extent possible we will try to cover. Now, before moving on to section 15, let's just have a quick recap of from where this section 15 begins its journey. So everything starts with section 4 in the Income Tax Act, that is the charging section for the whole act. Just like how we have charging sections for each and every chapter, we have a charging section for the Income Tax Act as a whole, which is section 4. And section 4 brings about a charge of income tax on an assessee. So it says that income of an assessee will be chargeable to income tax in the previous year. That is relevant to the assessment year. So it starts with that. And what is income? That is defined under section 224 in a very wider manner. It's an inclusive definition which we all know. From there, so we know that there is a charge which is getting created under section 4. From there we move on to section 224 where the income is defined. Then we know that okay, there is something called as an income. Then we will ascertain who is going to be taxed and in which year they are going to be taxed and to what extent. So all of these things will be answered by section 5 and 6. Section 5 speaks about scope of total income and section 6 speaks about the residential status. So we will determine the residential status of an assessee under section 6. We will fix either say it might be a resident and ordinarily resident, or it could be a resident but not ordinarily resident, or it could even be a non-resident. So we will determine the residential status of the assessee for that particular previous year. Then we will move on to determine what nature of income or what is the scope of total income for that particular assessee. And that is being provided under section 5. With respect to salaries, if we just take from the perspective of salaries, what could be the scope of total income in the hands of resident and ordinary resident, and for resident but not ordinary resident or a non-resident. So that is being very clearly laid down under section 5. Section 5 says that for a resident and ordinary resident, their global income is taxable, meaning so it comprises of 3 parts. 1. Income which accrues or arises in India. Number 2, the income which is deemed to accrue or arise in India. And then income which is deemed to accrue or arise or arises or accrues outside India. And the third one being income received or deemed to be received in India or outside India. So for a resident and ordinary resident, wherever it accrues, wherever it is received, it will be taxed in India because they are a resident and ordinary resident. And we follow, it's not a territorial system that we follow, so the global income of a resident and ordinary resident will be taxed. So therefore, if a particular category of, if a particular taxpayer is categorized as a resident and ordinary resident, his salary, wherever he earns it, wherever he receives it, it will be taxed in India. This will be from the perspective of salary chapter. The next thing. If a taxpayer is being characterized as resident but not ordinary resident or a non-resident, then section 5 says the scope of income that is taxable in those assessees' hands will be only those income which accrues or arises in India or is deemed to accrue or arise in India, or income which is received in India, meaning thereby salary which gets accrued or which arises in India, or which is deemed to accrue or arise in India, or salary which is received in India. So only if these conditions are satisfied, the salary income would be taxable in the hands of a resident but not ordinarily a resident or a non-resident. Now the question arises as to what is the salary that is deemed to accrue or arise in India. So for this we need to refer to section 9. And section 9 says income which falls under the head salaries, if it is earned in India, so it has two criteria. One is if it is earned in India, the other one being if it is payable by the government to the citizen of India for services outside India. So these two conditions, either of these two. So if our case falls in either of these two, then that salary will be deemed to accrue or arise in India, and therefore it will be taxed in the hands of R but not or a non-resident. Now, when a salary is considered to be earned in India, again the answer is given in section 9 itself. So here it says the salary is said to be earned in India if it is for the services that is rendered in India, or the rest period or the leave period which is preceded and succeeded by the services rendered in India and forms part of the service contract of employment. So all these things will be considered to be earned in India. Basically, it just says salary for the services that are rendered in India will be considered to be earned in India, and therefore it is deemed to accrue or arise in India. So just to summarize what we saw just now. One, if it's going to be a resident and ordinarily a resident, salary earned outside India, in India, salary received outside India, in India, everything will be taxed in India. If it's going to be if it's going to be a resident but not ordinarily a resident or a non-resident, then only those salary which is deemed to accrue or arise in India, or salary which is received in India, only those things will be taxed. And when it is deemed to accrue or arise in India, only when the salary is earned in India. So with this, we will move on to the specific provisions of salaries. Section 15 is the charging section for the salary chapter as such. Just like how we saw section 4 as the charging section before that, section 15 will be the charging section for the head of income salaries. Section 15 says salary paid or payable or allowed by the present or past employer to the employee will be taxable either on due basis or on receipt basis, whichever is earlier. So this is what the charging section says. So let's break it up into parts. The first thing is there should be a salary. Now what is meant by salary? It is defined under section 17(1). We will move on to that definition after some time. So there should be salary, then only there will be a charge of income under the head salaries. The next thing is the salary should be paid or payable or allowed. Now we might wonder, paid or payable is something which is sinking with the word salary, because salary is getting paid. You might think, why is this term allowed being used in the provisions of the Act? If you see the bar Act, the term allowed being used. So why is this used? So if you just recollect the provisions relating to perquisites. So say for example an employer is giving a house, say rent-free accommodation to an employee. There we cannot say rent-free accommodation is being paid by the employer to the employee. In that case it's being allowed by an employer to the employee. So in the case of a non-monetary benefit or a perquisite that is being provided by the employer to employee, there the term allowed takes its significance. So therefore the wording of allowed is being used in the provision. Now so salary will be paid. So salary paid, payable or allowed by present or past employer to the employee. So here comes the question. It says by the present or past employer to the employee. So there should be an employer, and if there should be an employee, it's only the transaction between an employer and employee that will give rise to the income that is chargeable under the head salaries. Now what is that employer-employee relationship? That was the subject matter of dispute for several years, and still now it's factual. So it will be decided on a case-to-case basis. Let's also see a few interesting case studies in a few minutes on that. So this is what is given in the charging section. It says that this salary will be taxable either on due basis or on receipt basis, whichever is earlier. Now again the question arises as to what is meant by due. Let's also see a case study on that. And then we know about receipt because receipt will always be substantiated by the credit in the bank statement. So therefore, receipt is something which is easier to understand comparatively. So here the charging section says salary will be taxable either on due basis or on receipt basis, whichever is earlier. And it clearly provides through an explanation saying if it is taxed on due basis, again it will not be taxed on receipt basis. And if it is taxed on receipt basis, say in the case of an advance salary, it will not be again taxable on due basis. So this provision is clearly mentioned in the section. No dual taxation. And the last thing, there was an explanation too which was inserted by Finance Act 1992 that also clarifies that any salary, bonus, commission or whatever remuneration that a partner receives from a partnership firm. So that will also be taxable under the head P, it will be not the salaries. So it is just being clarified that it will not be covered as a part of this chapter, the salary head of income as such. So this is what is being provided under section 15. Now let's move on to an interesting case. Employer-employee relationship. So there have been several case laws on this to determine whether there is an employer-employee relationship between two persons. So I have just codified a few which would be useful for us to determine whether at all there is an employer-employee relationship. Point number 1. Between two persons, if one person is able to supervise and control the work that is done by the other person, then we can say that there is an employer-employee relationship. So these are all based on several rulings which has come up in the past. So the main thing that they have considered is the supervision and the control over the work done by the employee. So if there is an employer-employee relationship, then there will always be a supervision and a control over the work done by the employee. So that will substantiate this. And the next thing, if we take the Supreme Court ruling in the case of DC Works Limited versus State of Saurashtra, that was not in the context of income tax, but still that said what would tantamount to a relationship of an employer-employee. So that said that directing the employee to work in a particular manner, so that directions given by one person to another, that will make the relationship as an employer-employee relationship. So if this is being compared with, say for example, a consultant and a client relationship, or say for example, a principal and an agent relationship, there this level of supervision and the control over the work done and this level of direction cannot be given. Say for example, the principal can say this is what you need to do, but he cannot go for a micromanagement level and then say that no, you need to do this, otherwise I'll fire you. They cannot do that. And then similarly, a consultant and a client. So it's up to the consultant to provide the services in a particular manner. The client can just say that this is my requirement, and the consultant, they cannot restrict the consultant to do it in a particular manner. And the level at which this restriction can be placed is very much higher in an employer-employee relationship scenario as compared to the other two scenarios which we saw. The next thing is responsibility to bear losses. If we take consultant, so the consultant is responsible for his own business, for his own professional career. Whereas in the case of an employee, whatever mistakes he does, it affects the business, but the employer is getting affected financially and it's not the employee. While he might be responsible for his own role, he is not responsible for the whole business as such. So therefore, that responsibility to bear loss was also considered as one of the points by Allahabad High Court. The next thing is right of selection and suspension or dismissal. So an employer will have a right to select an employee, an employer will have a right to dismiss or suspend the employee. Of course, the employee will also have a right of being heard, a right of getting an opportunity of being heard, but at the same time, the employer will have a superior right over it. And this will help us determine the employer-employee relationship. Regularity in payment of remuneration. So whatever the employer gets, whether there was some business which was being done in that month or not, the employee always gets the remuneration, the regular remuneration. That will also help us to determine this kind of a relationship. So with all these factors, now again, all these factors needs to be cumulatively seen and it needs to be adapted to these scenarios because each and every factor cannot be available in every scenario that we see. So it needs to be adapted based on the case that we handle, and based on that we need to determine the employer-employee relationship. These are some of the factors which are being handled by the in those jurisprudences. And lastly, when this employer-employee relationship is said to be ceased, then there is a cessation. So So, say for example, a person puts his papers. Only when the employer accepts that resignation, then only the employment stops. So, until then, whatever income that the employee receives, that will be taxable as salary. Now the question arises. At this point, the question might arise, okay, after my resignation, if I receive something, so will that be taxed as a salary or should that be taken to income from other sources? No, so that will also be taxable as salary because there are specific inclusions. Say for example, the actual date of credit of gratuity might be after the date of resignation or retirement, but still it is getting taxed under salary because there is a specific inclusion in the charging section read with the definition given in the section 70. So therefore, though there are these kind of interpretations, there are allowances given under the provisions of the Income Tax Act, which makes us include a particular. Now let's move on to the next case study. Can a HUF be an employee?
No, he cannot be an employee.
Sorry?
No, HUF cannot be an employee.
Okay. Can someone say the reason?
Because only an individual can enter into a contract. The HUF cannot enter into that because it doesn't have a legal fiction.
If the HUF cannot be an employee, otherwise, but can a HUF earn income in the nature of salary?
No, it cannot earn income in the nature of salary.
Okay.
HF earns?
Income in the nature of salary. Income which is taxable under the head salary.
Cannot receive.
It should not. Even that was my thought. But when I read this case law, I was too much surprised, and I think you will also get surprised. So even HUF was held to be an employee in a particular
There has
case.
been various Supreme Court orders have come subsequently which have disallowed all salary to the even to a karta. He can receive only in his individual capacity, not in the capacity as a karta.
Correct. So there are rulings in favor of it, and there are rulings against it as well. But there is nothing like one ruling which is ruling down the other one, distinguishing the other one. So therefore, we will also take the rulings which were interesting in this context. So one set of ruling is, say, if we take the ruling of Kallu Babulal, wherein the question before the Supreme Court was where this person was appointed as a managing director in a company. So he was the karta of a particular HUF, and he was running a business, and he wanted to corporatize the structure. Therefore, he set up a private limited company. In that private limited company, he was appointed as a managing director. Now, if you see why he got the post of managing director is of course an office. Right? So it's just the post which he occupies. So why he got that post of managing director? So to that extent, the Supreme Court went on in detail, and then they said that so this person has got the post of the managing director because he has contributed much to the company. And how he has contributed, it was only through the resources of the HUF. Therefore, HUF was held to be the employee, and the salary income was also taxed as much to the HUF. It was quite an interesting ruling, but this is just for us to know that okay, something like this has happened.
Which year it is?
It was in 1959.
After 74, everything has changed.
But this is just for us to know that there was something like this in the past. And of course, like as Sir said, there was one other Supreme Court rulings, and there are many other rulings. Say for example, Diamond wherein the same question, whether an individual is said to be an employee or whether a HUF is said to be an employee was taken up. Here, the employee was the treasurer of the bank. The individual was the treasurer of the bank. And in that particular case, it was held that no, it was in his individual capacity that he is rendering whatever services that he is doing to the bank, and therefore it's only the individual who is the employee. And it's not the HUF resources that is getting used for the purpose of rendition of services. So in this case, it was concluded that the individual was the treasurer and the treasurer employee of the bank. And therefore, the salary income was also taxable as the individual. So there are contradictory rulings, but some interesting aspect is that even HUF was held to be an employee in the past. Now, next. Again, one other interesting ruling. Can judges of the court the salary that is earned by the judges of the court. So whether that will be taxable under the head salaries or not. Okay, right? Okay, it is exempt. But if at all it is taxable, then under which head of income would you fit it?
Other sources?
Okay, any reason behind it, sir?
That is my employer-employee relationship.
Right, exactly. So that was my thought process as well. But again, the ruling gives us a surprise. So there was a ruling in the case of DOK Agarwala Justice. This is Union of India. This came up in the year 1999, wherein they said that they hold a position. And though there is no proper employer in place, it's a contractual relationship, and they hold, say, a constitutional, say for example, they hold it because of the constitutional right that is given to them. They hold an office, so it's not something like they are out of the employer-employee relationship. They are into employer-employee relationship. They receive regular remuneration. Just because there is no formal employer above that person, it cannot be said that the earnings that they are getting will be taxable under the head IFRS. So that was the conclusion that they gave. So there they said that judges of the court are also employees and their income will be taxable as salary. So they considered that what is relevant is just the employment and it's not whether they have a formal employer or not. This was also a surprising ruling that was given in the past, and therefore judges of the court, if they are receiving some remuneration, that remuneration will be taxable only on their salaries. The next interesting case study. So we might have come across many.
Excuse me.
Yes.
When the judges are paid, it's called salary also. When they are paid, so you
Yes,
name it as.
correct, it is
when the
termed
payment
as
is
salary.
made, they pay it as salary. So
Yes.
that also means that it is salary.
Yes, that also supports this argument. The next case study. So we might have come across in several scenarios that doctors might be employed in a hospital. At the same time, some doctors are also acting as a professional consultant. Say for example, in his professional capacity he will act, but not as a regularly paid salaried person in a hospital. Similarly, lawyers. So lawyers are also employed in an organization, and at the same time lawyers also take the professional capacity and they will be paid just the professional fee. So in that case, which will help us determine whether they are employed as a salaried person or they are acting in their professional capacity. So this will even apply for us, for CAs like us, because some firms will take CAs as professionals and some firms will take CAs as say a paid assistant with the characterization of salary being paid. So in that case, how do we determine whether it's a salary or not? So there are several Supreme Court rulings, but one interpretation which strikes a lot is the interpretation given by Justice Rowlatt in Great Western Railway Company versus Batter. So in this case, what he said is, if a person holds an office, then he is said to be in an employment relationship. An office is something which is replaceable. Say for example, if there is an office, Mr. X might come in and Mr. Y might replace X. After a few months, Mr. Z might replace X. So it's just an office, a position which a person holds. In that case, yes, there is an employer-employee relationship. If he doesn't hold an office, but he just comes, renders services, whatever is required, then he goes off, and there is no regular payment kind of thing, then in that case, it's not an employer-employee relationship. There you can characterize it as a profession. So this was the guidance provided. So based on this, I think this would help us in determining whether there is an employer-employee relationship even in the case of professionals. Let me go to the next case study. Due. So in section 15 we saw that salary will be taxable either on due basis or on receipt basis, whichever is earlier. So the term due is not something which is defined under the Income Tax Act, but there are again several jurisprudences in this context to say what is meant by due. So in the salaries. There are a few rulings which might be of relevance. One is LW Russell, Supreme Court ruling 1964, 53, 91. So wherein the Supreme Court ruled that there will be an obligation on the part of the employer to pay the amount and the right on the employee's part to claim the same. So only when this obligation and right matches on a particular date, that will be considered as the date on which the salary becomes due. Now how is this relevant? Say for example, the salary of a particular month, say salary of the month of Feb, will be paid in most cases in the month of March. Some employers do pay it in the month of Feb itself, say for example on the last day of Feb, something like that. But some employers will pay it in the next month. Now the question arises as to when it becomes due. Why is this relevant? Because if this cycle goes on, say for example, if the salary becomes due on the last day of every month, then in that case, April month salary will become due on April 30. May month salary will become due on May 31. Similarly, April to March salary will become due on the respective last dates of those months, and therefore the previous year's salary will comprise of April to March month salary. If suppose April month salary is said to be due only on May 1st, then there is a change in the cycle. So it's only the May to April cycle which will be taken for the previous year, or say March to April cycle. So that will be the thing that will be taken for a previous year's consideration. So the term due is something which we need to give significance for the purpose of determining what is the salary that is getting taxed in a particular previous year. But in most of the cases, how we practically do is, we just see the 26 years, we just see the 16, in form 16, whatever salary is given, that we will consider and then we close it out. So that is how we usually do in practice. But technically speaking, we need to determine when it is becoming due and when it is received. Of course, advance salary will be taxable on receipt basis, but the other salary, the regular salary that we receive, will be taxable on due basis, and when it becomes due, on the last day or on the next day or say for in the next month first day. So that is something which we need to determine. And there is one more guidance given by the Bombay Tribunal in the case of B.K. Hamid. So there they have said that the word due means the right to demand payment as arisen to the employee, and such right should arise from the contract of service. So this is something which we need to look for. The next case study is on the tips that is collected in a hotel, in a restaurant. So say, let's take an example where the restaurant collects the tips on behalf of all the people who are working in that restaurant, and they put it in a tip box, and that gets distributed to all the employees on a particular date. In that case, whether the tips that are being distributed by the restaurant to all the employees of that hotel, so whether that will be taxable under the head income from salaries or income from other sources. Any cases? Yes. Perfect. So there is a ruling as well. That was in the case of EIH Limited versus TDS officer, and it says that there is no employer-employee relationship with respect to this particular payment, and therefore this is not taxable under the head salaries. This will be taxable under the head IFRS. Now the question arises: what if it is under salaries or IFRS? What is the big difference that it is making? Yes, there is a big difference, because salary may, like we will have only the standard deduction or the deductions that are being allowed under section 16. Whereas income from other sources, we will have a right to claim whatever expenditure that we incur in relation to the income that we earn as a deduction under section 57. So there is a difference. So therefore it takes its own significance in determining whether a particular income is taxable under the head salaries or under the head income from other sources. Now let's move on to the next section. Section 16. It's a very less weighted section. So it just says there are only 3 deductions. One, standard deduction of ₹50,000 per annum. The second one being entertainment allowance, which is allowed only for government employees, and this is to the extent of 1/5 of the salary, or ₹5,000, or the actual allowance that is received, whichever is lower. And the last one being professional tax paid, which is capped at 2,500 at least for government purposes. So only these are all the deductions that are allowable against salary income that is taxable under section 15. So the taxability gets determined under section 15. Section 16 provides us the deductions. Now we will move on to the definition of salary, which is given under section 17.1. So 17.1 defines salary in an inclusive manner. It's a very wider definition, and it could include anything and everything that is being paid to the employee in an employer-employee relationship. This is how it is being defined. Salary includes wages, annuity or pension, gratuity, fees, commissions, perquisites, profits in lieu of salary, etc., advance salary, leave encashment, annual contribution in excess of 12% of salary, and annual accretion in excess of 9.5% per annum towards RPF, and employer's contribution towards LPS of Agreed Corpus Fund, which is recently introduced. Let's move on to each and every component of this and study what is it. The first thing being wages. So wages include whatever remuneration that is being contractually agreed between the employer and the employee, and it includes allowances, whatever components and whatever name that it is called for. So it includes allowances mainly, and there are a set of exemptions which are provided for allowances. Say for example, section 10 subsection 14 provides for exemptions of in respect of allowances, and that needs to be read with rule 2BB of the income tax rules. I'm not going into so much detail into that because there is a separate session on the exemptions alone. I think they are covering it, so therefore I'm not just going into in detail on those exemptions. But wages and allowances all are taxable, and they get salaries as it is included under section. The next thing being annuity or pension. We will go into detail on this in a few minutes. And then gratuity, again we will also move in detail on this. Then fees, commissions, perquisites, profits in lieu of salary. Perquisites is being defined under section 17.2. Profits in lieu of salary is defined under section 17.3. So we will go through those definitions. Then advance salary. Advance salary is something which the employee receives from the employer in advance, maybe for whatever requirement that he or she has. This advance salary needs to be distinguished from salary advance. So advance salary is something in the nature of salary which is being received in advance, whereas salary advance is like a loan which will be recovered from the employee. Therefore, salary advance is not taxable under the head income from salaries, whereas advance salary is taxable under the head salaries.
What is the difference exactly?
Advance salary is the salary which is received in advance. That's it. So say for example, if I am receiving June month salary now itself, then it's an advance salary. The other one is salary advance, or we call it as advance against salary. It's nothing but a loan that the employee receives from the employer, and that gets recovered every month from the employee's salary.
Be adjusted again.
Yeah, it will be adjusted against every month.
The LIC is paying annuity or pension. That is also salary.
That is also salary. Leave encashment. Here we will go into detail on this. And then annual contribution in excess of 12% of salary, and annual accretion in excess of 9.5% per annum towards recognized provident fund. So as you all will know, there are 4 types of provident funds at least for the purpose of Income Tax Act. One being recognized provident fund, which is approved for income tax purposes. The other one being unrecognized provident fund. The next one being statutory provident fund, and the last one being public provident funds. So as far as recognized provident funds are concerned, employers will contribute, and if the employers are going to contribute in excess of 12%, then that excess amount will be taxable as salaries in the hands of the employee. Similarly, on that employer's contribution, there will be an interest which will get added. So that interest amount in excess of 9.5% per annum, if at all it is allowed in excess of 9.5%, then that excess will be taxable in the hands of the employee as salary. As far as unrecognized provident funds or statutory provident fund is concerned, employer's contribution are not included as a part of employee salary. That is not taxable. And again, because in the case of unrecognized provident fund, at the time of receipt of, at the time of withdrawal from those funds, that will get taxed in the hands of the employee, and therefore at the time of contribution there is no tax. And in the case of statutory PF, it's exempt, therefore there is no taxation. And at last, in the case of public provident fund, that is also not taxed because then individuals like from the employer there will not be any contribution and there is nothing to be taxed in the case of public provident fund. Moving on, the last one is something which is introduced recently. Employers' contribution towards national pension scheme was available earlier. Now they have added Jubilee corpus funds. So whatever employer contribution that exists, so that will be taxable in the hands of the employee as a part of salary. Now we'll go into each of these parts in detail along with the exemption. The first one being pension. So as far as pension is concerned, as we all know, there are we can categorize it into two different types. One being commuted and the other one being uncommuted pension. Uncommuted pension is something which is received on a monthly basis or on regular intervals, and uncommuted pension is taxable for all categories of employees. There is no exemption that is available. So that is fully taxable. Whereas if we take commuted pension will be taxable only for certain categories of employees, and who are all those? For employees of central government, local authorities, statutory corporation, members of civil services, defense services, etc., the pension, the commuted pension will be exempt. It is exempt under section 1010A. If we just keenly notice on this point, it just says employees of central government. There is no specific mention about state government. Therefore, employees of state government, whatever pension that they receive, it will be taxable. There is no exemption that is provided under section 1010A. The next, they will be characterized as a part of other employees. Now for other employees, if the employee is in receipt of gratuity, then the manner of exemption is quite different. And if the employee is not in receipt of gratuity, then the manner of exemption is different. They also get exemption, but just the quantum of exemption is different. Section 1010A provides for the computation. If the employee is in receipt of gratuity, it says 1/3 of commuted pension received divided by the commutation percentage multiplied by 100. So that amount will be exempt. So the rest of the amount that is received as a commuted pension will be taxable in the hands of those employees. If we take the other case, if the employee does not receive any gratuity, in that case it's only 1/2. It's 1/2 which is exempt, and the balance will be taxable in the hands of the employees. This is how the pension taxation works.
And what is in etc. It has mentioned etc. So what are the list of employees? Where can we find that?
That etc. is still not defined. There is no rule or a notification which has been introduced for that. So even in the section it just says that.
No, that's what.
Gratuity is fully exempt.
Gratuity is fully exempt for this category of employees, not for everyone. Okay, sorry. Gratuity will come. This is only for pension. Section itself says etc. Next we'll move on to gratuity. So gratuity, if it is received during the service, it is entirely taxable. If it is received at the time of retirement, say after retirement or say after resignation, because even if people just shift from jobs, and if they are shifting after say 5 years, then they will be in receipt of gratuity, and that gratuity will also be taxable. How it is getting taxed, that we will see here. So if it is received during service, it is fully taxable. If it is received at the time of retirement or death, in that case, it is not taxable. It is fully exempt for employees of central government, members of civil services, local authority employees, etc. Again, there is no mention about state government. Therefore, for them, they will be categorized under other employees, and accordingly, the taxation will follow. Then, for other employees, if it is covered under POGA, Payment of Gratuity Act, then the manner of computing the exemption will differ. And if they are not covered under POGA, the manner of computation of exemption will differ. But the exemption applies for them. So how much is the exemption for those who are covered under POGA? It will be these from the following. 20 lakhs is the maximum cap that is being provided for gratuity right now. Then actual gratuity received, and then it's 15 divided by 26 multiplied by the last drawn salary and multiplied by the number of years of service. And if the number of years of service in fractions, if it exceeds 6 months, we can also round it up to the next higher number. So this is being provided for those people who are covered under POGA. It will be least of these which will be exempt, so the balance will be taxable. If say for example a person receives gratuity at the time of resignation, and at that point in time they would have been taxed. Say for example, if they have received something during service and they were taxed, and later at the time of retirement if they receive something again, then how do you calculate this gratuity limit? 20 lakhs. So this 20 lakh limit is a lifetime limit for an employee. So unless and until there is an announcement from the finance minister to increase this limit will apply for the lifetime of that employee for that particular SSC. So that is how we need to calculate. And for BOGA, salary would be basic plus dearness allowance. There is nothing else which is included. So allowances we will not include, bonus we will not include, performance we will not include, no other whatever terms that it is being paid, those things will not be included for the purpose of computing exemption. If the employees are not covered in the Payment of Gratuity Act, then again the limit is 20 lakhs and actual gratuity limit, actual gratuity receipt. The last one will be half a month's salary. So as against 15 by 26, here we replace that with half a month, which is 1 by 2. Multiplied by there, it was last drawn salary. Here it was the salary that was drawn based on the average of last 10 months. That is the difference. And there it is number of completed years. You have a right to round off, whereas here there is no round off that is applicable. So it's only the fully completed years of service. So fully completed years of service doesn't start exactly from the start date of the financial year. It starts from the start date of your employment. So if you are employed say on 1st October, then the completed year will be, or the first year will get completed on 30th September of the next year. So it gets calculated in that manner and it doesn't get started from the start of the financial year. So that is how we need to calculate, and if it is not covered under BOGA, then the salary will be defined in this manner. Basic plus DA if it is provided in terms of employment, and fixed percentage of commission. So if that is also provided, then that is also included as a part of salary for computing exemption. And apart from exemption, the remaining gratuity that is received will be taxable in the hands of the employees.
Why it is 15 by 26?
26 is after reducing 4 Sundays. That is also basically it's half a month, but just that they don't consider Sundays. Now we move on to the next part of the salary, section 17(3), which defines profit in lieu of salary. So here these are the components. The first component being compensation on account of termination of employment. So here, if we see the nature of the income that is being included as a part of profit in lieu of salary, everything will be like at the time of termination, if you receive something that will be taxable as salary. So something which is abnormal and something which is not being paid during the terms of service, during the employment period. So that is what is predominantly covered as a part of profit in lieu of salary. Say if we take the first case, it's a compensation on account of termination of employment. So if you receive something, then that will also be taxable as profit in lieu of salary. Compensation on account of modification of terms and conditions of employment. Say for example, your salary is reduced because there was an acquisition of your employer by the other person. So therefore your salary is reduced, or your grade is being reduced, or the terms of employment have changed. So if in that case, if you receive any compensation, that will be taxed as profits in lieu of salary. Then the third one being payment from PF or other funds. We have already seen gratuity fund and the pension fund. So if there are any other funds, say superannuation fund or some other funds from which you receive at the time of say retirement or resignation, or wherever you meet that requirement criteria, from those funds whatever you receive, that will be taxable as a part of profit in lieu of salary, subject to the exemptions that are provided under section 10. Then the next one being amount received under say pursuant to a key man insurance policy. And the last one being payment received before joining an employment or after cessation of an employment. This is quite interesting because if we see section 15 would have said salary which is paid or payable by the present employer or past employer. So there two types of employers are covered. Here if we see even future employers are covered. So before joining an employment, if you receive something from your employer, that is also getting taxed as a part of salary under this provision. And after cessation of employment, if you receive something, that is also included, and that is already referred to over there in section 15 as something which is received from the past employer. So this is the scope of profit in lieu of salary. Then the leave encashment provision. Again, this is something which is similar to gratuity. Here it says if it is received during the period of service, then it is fully taxable. But if it is received on retirement, whether on superannuation or otherwise, if you are a government employee, then it's fully exempt. Here if you see the wording that is used, it just says government employee. It doesn't say about whether you are a central government employee, state government employee, local authority, defense authority, nothing. So it just says if you are a government employee, then it is fully exempt. So literally it meant like if you are a state government or central government employee, you should avail the exemption. On the other hand, if it is received by any other employee, then least of these will be exempt. The limit is 3 lakhs, that is fixed for leave salary for now. And then the next one is actual leave salary that is received. Then 10 months salary on the basis of average salary of the last 10 months preceding retirement. Then the last one being cash equivalent of unavailed leave to his credit. So, and that earned leave entitlement cannot exceed 30 days for every year of actual service. So you will accumulate whatever number of days you have not availed leave. So you will accumulate that number, you will have that number, you will multiply that with the salary. Cash equivalent of unavailed leave will be the last component. So you will compare all these numbers, least of these things will be exempt and the remaining will be taxable. This is for other employees, for government employees, entire thing is exempt.
3 lakhs is not for a lifetime, no?
3 lakhs is for a lifetime.
Isn't that increase?
It's for that employee.
Isn't that increase to
Sorry?
something 25 lakhs?
I don't think it's for leave encashment. Then the bigger part of salary being a non-monetary portion of remuneration that is being given. And that is what is termed as perquisite, and that is also defined under section 17. So before we move on to this, I'll just pause for a minute if you have any other clarifications or if you would like to add any notes. Happy to do it. So section 17(2) it defines perquisite. Thankfully, this is an exhaustive definition. So it has 8 clauses. So we will go clause by clause, and each clause will have a corresponding valuation methodology that is given under Rule 3 of income tax rules. So we will also revise those rules as we go along the clauses of section 17(2). 17(2) clause 1, rent-free accommodation. So there is a revision of this particular rule very recently in 2023. So we will read through the new rules. We will also compare the old one with the new one. So if a house property accommodation is being provided by the employer to the employee, then in that case this rent-free accommodation will get kicked in, because it's a benefit or a perquisite that is being given by the employer to the employee. Basically, what is this perquisite? It is something which is paid or which is allowed in addition to the regular payment of salary. So that is what is being generally defined as a perquisite. If you take Black's Law Dictionary, it just says anything that is paid in addition to the normal salary. So that is how it is being defined. So if we go into the nuance of this particular term, so we will have a list of perquisites which is already given in Rule 3 and 17(2). And apart from that, there is also a general gyan which is included to say anything, any benefit that is provided by the employer to the employee, that is also a perquisite. So that's how, like, even though it's an exhaustive definition, there is an inclusiveness which is included as a part of that definition. So the first thing is 17(2)(1), rent-free accommodation. So the first one being house property accommodation. So if it's a government employee, Then the value of the perquisite. So how is it valued? In case of the government employee, the license fee will be fixed as per housing allotment scheme of the government. So that license fee will be the value of the perquisite. That will be fixed for each and every house property by the government, and that license fee will be taken as the value of the perquisite. And if it's a furnished house property, then in that case, that will be topped up by 10% per annum of the furniture cost or the actual hire charges of the furnishings, if it's going to be a furnished property. This is for government employees. For non-government employees, it gets broken down into two parts. One is if the house is owned by the employer, the other one being house taken on lease by the employer. The first thing is, if the house is being owned by the employer, then the perquisite value is calculated as 10% of salary. So if we just look into this valuation, the property, the benefit that is given by the employer to the employee in terms of house property is that being valued based on the salary that is given. It's not valued based on the property. It is valued based on the salary that is given. It is given in terms of salary. That is how it is being valued. So if we just take this as a comparison to income from house property. So there we value a property based on the fair rent or municipal rent or the rent that it fetches. Right? Whereas here, the same house property, when it is being given by the employer to the employee, it is being valued on the basis of salary. But still, this is the valuation methodology that we are following.
This purpose, salary includes all allowances.
Yes, it includes all allowances, but it excludes few things. See, it excludes dearness allowance, PF contributions, all those things are excluded. But it includes all other allowances. So 10% of salary if the city population is more than 40 lakhs, and the rate is 7.5% of salary if the city population is between 15 lakhs and 40 lakhs. 5% of salary in other cases. Here, if we just keenly notice, one is it is dependent on the salary. The second one is it bifurcates based on whether the location is a city or not. The next thing is it depends upon the population of that particular city. So with all these factors kept in, the valuation is being done for non-government employees. If we consider the house that is taken on lease by the employer, then it is 15% of salary or lease rent, whichever is lower. And if it's a furnished house property, 10% per annum of furnishing cost or actual hire charges will be total. So this is how it is getting valued. Now, a quick summary of how this was earlier and how it has got changed now. So this is a recent CPTT notification number 65/2023, which came out in August 2023. So if we see the left hand side, this side of the table, so this was the valuation given earlier, wherein it said that if the population of the city was more than 25 lakhs, then it's going to be 15%. And if the population was between 10 lakhs and 25 lakhs, it was 10%. And the rate for less than 10 lakh population cities, it was 7.5%. This was fixed based on 2001 census. And now they have changed it based on 2011 census. So now the limits have changed. Earlier it was more than 25 and now it is more than 40 lakhs. Earlier it was 10 to 25, now it is between 15 to 40. And the lower benchmark was fixed at 15 lakhs. This is based on 2011 census and the rates have also changed. 50 10 is 7.5, now it is 10, 7.5 and 5%. This is how it is being changed. One interesting part to note from this notification is, there is a formula, there is a rationalization in the valuation that is given. Because if you see, if you just take our country as a whole, so there is inflation. So the property values are increasing like anything, right? At the same time, the perquisite is being valued on the basis of salary. It doesn't have anything to do with the property valuation, right? So sometimes what happens, your salary might increase 10x, but your property value might not increase 10x. So the benefit that you are giving might not be of that higher value, But just because the salary has increased, you might be, say the perquisite value will be higher, right? So just to rationalize that part, the government, the CBDT has come up with a formula. They've said that the perquisite value will be restricted to the indexed value of the perquisite of the first year's perquisite value. So let's take an example on this. Say for example, in financial year 2021-22, a person earns a salary of 20 lakhs. And let's assume that on this salary of 20 lakhs, 15% gets applied. Let's assume that he is in a city of 25 lakhs. Because it was financial year 2021-22, the value of perquisite will be calculated at the rate of 15% of salary. So 15% of 20 lakhs being 3 lakhs. So this was his perquisite value for 21-22. Now in the next year, his salary increases to 23 lakhs. Now generally what would have happened? On this 23 lakhs, say this CBDT notification has come in because it's in 2022-23 and this is applicable with effect from September 1, 2023. Say for example, this is calculated somehow and the number that is arrived at is 1.43 lakhs. This is the perquisite value for this year. In financial year 23-24, say for example it's 26 lakh 50,000 and from here this 10% perquisite taxation will apply and therefore 10% is applied, 2.65 lakhs is the perquisite value for 23-24. And 24-25 say the salary is 22 lakhs. So here what it says is, assuming 26 lakh 50,000 has got increased to 32 lakhs, but the property value has got increased only by say a lakh or two. That has not got increased to that extent. In that case, your perquisite value should also not increase by this much extent, right? It should only increase in the proportion of the house property value. It should not increase in the proportion of the salary increase. So therefore, they restricted saying the perquisite value in the first previous year for this purpose is being considered as financial year 23-24. Because that is when the notification has come in. So the first previous year's perquisite value multiplied by the cost inflation index of that particular relevant previous year. So in our case, in 24-25, what is the cost inflation index? That you will multiply divided by the cost inflation index of the first previous year 23-24. So in this case, if we just blankly apply the rate of perquisite on this salary, we will get 3,20,000. Because it's 10% on the salary, 3,20,000 is the rate. But now CBDT has relaxed to say that you can even calculate in this manner. So it says 2.65 lakhs, which is the 23-24 amount, that perquisite value, multiplied by 24-25 cost inflation index. It's not yet notified, I've just assumed it as 362, divided by the cost inflation index of the base year, which is 348 in this case, financial year 23-24. And whatever number that you get, 2,75,661. So the perquisite value will be restricted to 2.75 lakhs instead of 3.2 lakhs. This is the benefit that they are getting. So just to summarize what we saw now. So they have rationalized it in a manner that employees don't pay additional taxes just because their salary is increasing. The perquisite value will be calculated in line with the inflation that is happening in the country and not in line with the increase in the salary that they are having. Any thoughts or any inputs on this?
PY is like 265 year-on-year.
It will change. So for this purpose, they have defined it as 23-24 or any later year from when that perquisite is being allotted.
So for the next year, you will take P20.
No. So in this particular example, it's 23-24 because that is the first previous year.
So
But say for example, this person is provided the perquisite only 25-26. Then 25-26 will be the first previous year. Because that is when the perquisite gets allotted. So therefore that will be the first previous year. So it's 23-24 or the financial year in which the perquisite is allowed for the first time.
in your example, the next year the base will always be 269.
Yes, that's it. Any other thoughts?
Change of employment, like from the previous employer will receive some value policy. Can that be considered?
Interesting question, but that's not addressed in the notification as such. I think it should be allowable.
So this means SC has to maintain the record.
Correct.
And it's very important. We have to connect record with my
We'll move on to the next class. Okay, I think we have not completed 17 to. So if the accommodation is provided at a concession and not as a free of rent, then in that case it falls under 17 to clause 2, and whatever rent that is recovered from the employee will be reduced from the value of purposes that we determine over here. And in case the accommodation is provided in a hotel, then up to 15 days. If say a person is being transferred from one location to the other location, and up to 15 days his stay will not be subject to any perquisite taxation, but over and above 15 days it starts from 0. So the perquisite value will be 24% of the salary paid or payable or actual charges that is payable to the hotel, whichever is lower. Whichever is lower. This lower is very important because 24% of the salary cannot be taxed in the hands of a person who has just stayed in a hotel for 16 or 17 days. So therefore it's signified using this word lower that only the actual charges payable to the hotel will be the cap for the perquisite valuation.
Sorry, sir, can you repeat please? Because there are a lot of multinational companies, they employ the directors, for example, Japanese companies, expats, stay in hotel. If I stop. So how does this apply?
Okay, so in that case, this hotel accommodation is something which is provided as a perquisite. So it's taxable as a perquisite in the hands of those employees. That is point number 1. Point number 2 is the actual charges that the employer, that the company pays to the hotel, that will be the cap. Or, I'm sorry, so that is not a cap as such, but that as compared to the 24% of salary. In your case, if the person is going to stay for say 4 or 5 months in a hotel, then the actual charges that is payable might even be higher than 24% of salary. In that case, 24% of the salary will be the perquisite value. So it's whichever is lower of these two. So either 24% of the salary or actual charges that is payable to the hotel, whichever is lower.
When the person is going on official trip as a traveling expenses, this entire thing is debited to the company's account, is not charged to the employee.
No, if
Say all directors travel on, they go on official duties.
correct.
Then it goes only as a traveling expenses of the company.
Not-
question of perquisites.
No. So if he is traveling for those travel expenses will be considered as for official duties, and therefore it's not a perquisite. But here what
What he
this
asks is
case
director
was,
traveling is all traveling expenses of the
No, sir.
company.
No.
Just to explain, in my case, Japanese people, when they come here, they don't stay in a house. Many of them stay in Hyatt for months.
On official duty.
Official duty for 6 months. 6 months, they come and stay. They don't stay in so they need all the facilities. Okay? The house cannot afford that facility. They stay in Hyatt, the gym, everything they use. Food, everything will be exclusive for them. Okay? It is very common nowadays. For example, Chinese people, they book 10 rooms in the floor. They stay forever. So it has to be RFA only. It is not traveling expenses. Right? They are an employee here. It is that way.
instead of a residential accommodation, they are being given a hotel accommodation.
They are doing that, sir. Many
And 24 hours cannot be considered as for official duty. So it's an accommodation, it is a perquisite.
Is it better instead of accommodate?
Not even 4-5 months. I stay for 2-3 years also. I have seen this friends.
Still could be a deputation.
Deputation only, absolutely. But it comes under RFA, rent-free accommodation only, right?
I'm sure unless
That is
what is his place of employment?
Yeah, that will be something which will determine whether it's a secondment and in what manner the salary is being paid, whether it all it's a salary or it's a service payment to the foreign company. All those things are something which is different from the taxation in the hands of those people who are actually deputed. So from the perspective of those people who are actually deputed, who are receiving the remuneration from the company, whether it's a perquisite or not, yes, it's a perquisite. Now we will move on to clause 3, 17.2, 3 and 4 is something which we can combine and recap.
Is there something called as traveling allowance?
Yes, there is a travel allowance, but it's not something which is exempt as such. But there is travel allowance which is 17.2.3 and 17.2.4. 17.2.3, any benefit or an amenity that is granted to an employee who is a director only for specified employees, but it almost covers all the employees factually. One is employee who is a director, the other one is employee whose salary is more than 50,000. This has been fixed years ago and this limit is still there, therefore all the employees are covered. The next one, an employee having substantial interest in the company, substantial interest would be 20% of the voting power. So if any benefit or an amenity is provided by the employer to employee, then in that case that's a perquisite. If we see this clause 17.2.4, it says if an employee has an obligation to meet and if the employer meets the obligation on behalf of the employee, then that will also tantamount to a perquisite in the hands of the employee. Now what is the difference between 17.2 and 3? 3 and 4. 17.3 is any benefit or an amenity that is provided by the employer to the employee. Here it's meeting the obligation of the employee. So here it's benefit or an amenity, here it's an obligation. So if we take 17.2.3, there is no obligation as such for the employee to meet those things. This is something which is provided in addition to whatever he expects by the employer. So therefore that will fit under benefit or amenity. Whereas if there is an obligation to pay by the employee and that obligation is being met by the employer, then that will fall into this clause. Say for example, as Sir was saying, there will be a lot of deputationists who comes to India and who stays here and their salary will be paid, and most people will not bear the taxes that are being paid to them. So all those taxes will be borne by the employers. And that is whereas the income tax is an obligation of the taxpayer, it's not the obligation of the employer. So in that case, the tax that is being paid, the tax on the employment income, which pertains to that employee. So if that is being paid by the employer, that is also a perquisite, and that comes under 17.2.4 because it's an obligation of the employee which is being met by the employer. That comes under 17.2.4. It is a perquisite which is taxable in the hands of the employee. Again, there is an exemption under section 1010cc. I am not going into it in detail because that itself will take a heart. So 1010cc provides for an exemption just to cap this tax on tax which gets multiplied because of this, because you are including a tax that you are paying for the employee in your hands. On the other hand, it gets disallowed in the hands of the employer and therefore it gets multiplied. So that gets stopped because of 1010cc. I am not going into it in detail, but there is something like that. So that is taxable under 17.2.4, whereas 17.2.3 is something which is provided in addition and the employee is not asking for it, but still you are providing it as a package to the employee. Then in that case it falls under 17.2.3. Now let's move on to the valuation. Rule 3, sub-rule 2 provides for valuation of use of motor car. So these are all benefits or amenities which are being provided by the employer as a part of the salary package to the employee. So say for example, so here we have different situations. So one being the car is also owned by the employer and expenses is also met by the employer. Whereas if anything, again any use of motor car, if it is being used only for official purposes, purely for official purposes by the employee, there is no purpose. But how to prove that it's only for official purposes? So the rule says there needs to be a log which is maintained from where this car has started and until where it has gone, and someone needs to sign. There should be a chauffeur who needs to sign it, and there should be a person who has travelled in the car who needs to sign it, and whether all those records are proper or not, someone will doubt on it. So therefore, this is something which is practically impossible for us to substantiate, but still there is an option that is given in the Act to substantiate it. So, if it is wholly for official use, there is no perquisite value, there is no taxation that arises in the hands of the employees. But if it is say partly for official use and partly for personal use, which will be most of the cases that we see in our practical scenarios. So here in this case, if the car is owned by the employer or if it is hired by the employer and the expenses are also met by the employer, in that case the perquisite value will be limited to 1,800 per month if it's a 1,600 cc vehicle, or 2,400 per month if it's more than 1,600 cc vehicle. And for the chauffeur, 900 per month will be added. So this is the limit of the perquisite. So whatever the expenses that you incur on behalf of the employee, say for example the employee might give you an invoice, a petrol invoice of say a lakh rupee, but still the perquisite value that gets taxed in the hands of the employees are only these. It gets limited. Now the next thing, if suppose car is owned by the employee and the expenses alone are met by the employer, again if it's wholly for official use, no value. But if it's partly for personal use and partly for official use, then the actual amount of expenditure that is incurred by the employer as reduced by this fixed amount. That will be the taxable value of the perquisite in the hands of the employee. And lastly, if the employer owns the car and employee just meets the expenses, then it's the same actual amount of expenditure that is incurred by the employer, whatever expenditure that he incurs, plus these things minus the fixed value. So this is how it is getting calculated. I think you would be familiar with these things. So I'm not just stressing too much on it, but this is how it gets calculated. This is the reflection. If it is fully for personal use, but still the employer makes the expenses, then in that case what will be the value of perquisite? The value of perquisite will be whatever running and maintenance charges, petrol, diesel expenses that is actually incurred, plus the normal wear and tear at the rate of 10% per annum, because it's being owned by the employer and also the expenses are incurred by the employer, but the employee uses fully for personal use. Mostly that would not be the case, mostly, because it will be partly for official and partly for personal use. In that case, the valuation is like this. If it is fully for personal use, say for example an employer might give 2-3 cars to the same employee, say for KMP. So in that case, one car might be fully for personal use, the other 2 cars might be used partly for personal use and partly for official purposes. So in that case, that car which is used fully for personal use, for that particular car, the perquisite value will be calculated in this manner, and for the other 2 cars, the perquisite value will be calculated in this manner. Then the next sub-rule on valuation, rule 3, sub-rule 3. Domestic servants, if the expenses are met by the employer, then that's a benefit, and whatever salary that is being paid to those servants, that will be taxable as a perquisite. Then gas, electricity, water, if it is supplied from its own resources by the employer. Say for example, the employer itself is a producer of gas. The employer itself is a producer of electricity, and that electricity is being supplied by the employer to the employee. Then whatever manufacturing cost per unit that is getting incurred, so that will be the value of perquisite in the hands of the employee. Now, how to calculate manufacturing cost per unit and what is this manufacturing cost per unit? There is no definition. So it is something which we need to substantiate with our own records. And if the resources are available from an agent, which will be in most of the cases, so in that case, the amount that is paid to such an agent will be taxable as a perquisite in the hands of the employees, and this is something which we can substantiate using the invoice copy that is being issued by the agent to the employer. So in the next sub-rule, sub-rule 5 of rule 3, where free or concessional educational facilities are provided to employees' children or member of household. So in this case, if the educational institution is maintained and owned by the employer, say for example there might be a lot of education institutions, say colleges, where lecturers are being employed and lecturers' son or daughter might be studying in that college at a concessional fee. In that case, what will be the value of benefit? So if it is being provided to employees' children, cost of such education in a similar institution or the nearby locality, that cost will be treated as the value of the benefit in the hands of the employee. But if the cost of such education or the value of benefit per child does not exceed 1,000 rupees per month, then there is no value. Of course, that cannot be a practical scenario in today's case. So therefore, this is something which can be ignored. The next thing is, if free educational facilities are allowed in any other educational institution, not in their own college, but in some other college or in some other educational institution, by reason of this being in employment of that employer. Say for example, Wipro has its own educational institution. So Wipro's employees are getting a concessional educational facility for his or her daughter or son. So in that case, that educational facility is being provided in some other institution. It's not Wipro's own institution because that will be a separate body as such, separate corporate as such. Then in that case, it's the same valuation methodology, there is no difference, but that will also be considered as a purchase. Then in other cases, the amount of expenditure, whatever that is incurred by the employer, in that behalf, that will be calculated as the value, that will be taxable as the value of the purchase in the hands of the employee. Now, this rule speaks only about the educational facilities that are being provided by the employee to the employee's children or member of household. It doesn't speak about the educational facilities or the expenses that are incurred by the employer on the higher education of the employee. Because we could have seen a lot of scenarios on that. Say for example, a person might be employed in a particular corporate and he or she might go abroad, study, or they might go in for say higher studies, say from an MBA from a B school in India, something like that. So in that case, if the employer is going to bear the expenses of that particular course, then in that case, whether that is a perquisite or not. Any thoughts? Obligation of the employee, then that obligation being met by the employer, so it will fit into the trap of 1724. But if it's not going to be the obligation of the employee, if say for example employer says, I want you to pursue this particular course, that is for the development of our office, say our corporate, you need to pursue this course. In that case, the employer is pushing the employee to do the particular course, and that is for the benefit of the company as such. In that case, it's not a perquisite in the hands of the employees.
How to prove that?
So they need to have sufficient documentation saying we are into this business, and this business will grow only if this kind of professional is there in the team, something like that.
The company is reimbursing instead of making the payment to the employee. Pays directly to the educational institution.
That is also the same. Just that whether the obligation arises from the employee's part or employer's part matters. So if the employer says you need to study this, then it's the employer who is pushing for it. There is no benefit that, of course there is a benefit that the employee gets because he earns that course, he earns that degree or not, he earns that professional certificate. But at the same time, it is being triggered because of the need of the employer and not for the need of the employee. In that case, it's not a benefit or a perquisite.
It is very judgmental.
Definitely. Everything is
very judgmental. So, sponsoring a CA student in our office. How do I do it? I will take it.
And the terms and all will also be seen. Say for example, there might be some contract between the employer and employee saying, I will push you to do this course and you need to be with me for another 5 years or 6 years to grow this team, something like that. So that can also help us substantiate that there is an obligation for him. So So this was also addressed by Delhi ITAC in the case of Natwarlal Gupta case. And here the assessee was a qualified CFA, and he was also working as an employee. Assessee executed a bond in favor of the company to serve the company for 7 years. Whereas here, the decision to undergo higher education was from the employer. So the employer pushed the employee to do higher studies. So therefore they did it. Therefore they said that it's not a perquisite because the obligation is that of the employer and it all arose from the employer's side. And they didn't mention anything about 17.2.3, but of course that might not be too much relevant because it's already addressed as a part of 17.2.4. Continuing with the next sub-rule 6 of rule 3, where free or concessional tickets are given. So here if the employer is engaged in carriage of passengers or goods, provision of free or concessional journey to employee or member of his household, it could be a personal or private journey or whatever journey it is. So that will be taxable as a perquisite at the value at which such facility is being offered to the public, less whatever is recovered from the employee. There are exclusions, it's nothing but airline or railways. So the other transporters, say if it's ABHINAYA, they are running a bus and their employees travel at a concessional rate. In that case, it is a perquisite and it will be taxed in the hands of the employees. If it's a SRM, they also run a bus. And if their employees travel at a concessional rate, it's a perquisite because it's a bus. If it is going to be Indigo Airlines providing a concessional ticket to its own employees, airlines are not covered and therefore they are not taxable in respect of the perquisite. If it's going to be Indian Railways, of course Indian Railways provides passes to its own employees. Those passes are not taxable because it's not a perquisite. There is a specific exclusion for railways.
All these rules, rule 3, rule 6, is this applicable to the specified employees or all employees?
It is for the specified employees, but currently it's almost like every employee will be covered because it's going to be a director or a person who earns more than 50k. 50k is per annum. So every employee will be covered.
But what if he is earning 35,000? Then it will not be applicable.
It should not be applicable.
So domestic servant,
not applicable.
It will go to IF.
No, why is it going to IF?
Listen, he is getting something from the employee. So from the employer. So something. So it is an income, kind of an income.
It is an income, but it is not taxable under salary because it's specifically excluded.
Yeah.
It's covered, but it's excluded. It's not something which doesn't even surpass these tests. So it gets tested, but it gets excluded. Say for example, you receive gratuity. There is something which is exempt under 10, right? So if it is exempt and the portion of exemption, will you tax it again under IFRS? You will not, right? In the similar way, here also it is passing that test because those conditions are not satisfied. Therefore, you will not subject it again under IFRS. So this is what is given for 17.2.3 and 17.2.4. The next one, 17.2.5. The employee's life assurance other than through RPF, superannuation, EDLI. So these are all something which is specified. So other than these things, if the employee pays something to assure the life of the employee, then that is a perquisite. And there is no valuation that is provided. Whatever they pay, that's a perquisite. 17.2.6 ESOP. The valuation of ESOP is provided under Rule 3 Sub-Rule 8 and Rule 3 Sub-Rule 9. Rule 3 Sub-Rule 8 is for equity shares, Rule 3 Sub-Rule 9 is for other instruments. So, the value is nothing but the fair market value of the instrument that is being provided. Whatever instrument, be it equity shares or any other instrument, CCPS, OCRPS, whatever they give. So, value will be fair market value. When this value needs to be determined, it should be on the date of exercise of the option. So as we all know, there will be a grant date, there will be a date on which the employees exercise that option, and there will be a date on which they sell those instruments. So there will be different dates that are involved, and there will also be a vesting period, a vesting date, depending upon the nature of the arrangement that they have. So here the date that is relevant for valuation of purposes is the date of exercise of option. So on the date of exercise of option, you will value it. How do you value? If it's going to be a listed equity share, then you will see whether it is listed on one stock exchange or more than one stock exchange. So if it is listed on one stock exchange, then on the date of exercise of option, whatever is the average of opening and closing price, that will be the fair market value of the listed shares. If it is listed on more than one stock exchange, you will pick a stock exchange which has traded in higher volumes on that particular date. So in that stock exchange, whatever is the average of closing and opening price, that will be treated as the fair market value. If say for example on that particular date there is no trading which has happened in the stock exchange, in that case the closing price of the closest and immediately preceding date in the stock exchange will be higher volume of trading. Say for example, a particular security has been locked by SEBI from trading on a particular date because it has reached the levels. So in that case, there is no trading which has happened on that particular day. So therefore, you will see the value of the preceding, the price, the closing price of the closest and immediately preceding day in the stock exchange with higher volume of trading. If it is not at all listed, if it's an unlisted company's equity shares, then the value will have to be determined by the merchant banker. Now again and again you cannot get a merchant banker valuation report, therefore the valuation is provided a validity of 180 days. So if you get a merchant banker's valuation, you can use it for 180 days. And this is only for unlisted shares. Then even for other instruments, say if it's going to be a preference shares, of course they will not issue debentures, but if it's going to be a preference shares, OCRPS or CCPS, whatever it is, in case of other instruments, the value will have to be determined by the merchant banker. Even in this case, 180 days validity will be there for the valuation report. Then the next one, there is a relaxation which is provided for startup employees, because if you see the salary package that is being offered by the startups, mostly it will have an ESOP component. So therefore, they came up with this intervention. It was recently introduced. This relaxation is provided only for recognized startups, not for every company which has just started their business, not like that. It's only for recognized startups. So ESOP will be taxable in that case. It's not at the date of exercise of option, but it will be the earlier of the period after the expiry of 48 months from the end of the relevant assessment year. So it's after the relevant assessment year, you are given a period of 48 months to pay tax on the ESOPs. So almost you get 5-year period from the end of the previous year. 5-year period. And then the next one being year of sale of security. If say for example you sell the security after 2 years itself, then in that case the taxation of ESOP will also happen in the year of sale. Then the last one being year of cessation of employment. If you come out of the employment in the first year itself, you get the shares but you come out of it, then in that case it gets taxed in that year itself. But it will be earlier of these. Say for example, sale also doesn't happen for 48 months. Cessation of employment also doesn't happen for 48 months. Then the ESOP will be taxed as a perquisite after 48 months from the end of the relevant assessment year has got over. So it will be taxed at that point in time.
This is very dangerous.
Dangerous from the income tax department.
No, dangerous from the employee perspective. So suppose the fair market value is 1,000 rupees, like Zomato, and then the exercise price is say 1 rupee or 2 rupee. So the tax has to be paid, no, by the employee, without even realizing the money.
That's right. That's why they gave this option.
No, startups, 4 years is very small, right? So what will happen in that year, the employee ends up paying for the amount which he has never realized.
That's right. They'll have to wait to realize it.
What will be the value in the case of startup? What will the value to be taken?
It will be the same, sir. It is date of exercise of option.
What is the value on that day that will be taken?
Sir, anyway, they will do a fair market value on that day, sir. Or even for accounting purpose, they will do. So that will be considered. So unfortunately, the differential between the amount which has to be paid by the employee will become the income in the hands of the employee. So he will have to pay without realizing anything. So we problematic.
The next clause under 17.2.7, which provides that contribution in excess of 7.5 lakhs towards recognized provident fund, NPS superannuation fund. So this will also be taxable in the hands of the employees. So if the employer contribute in excess of 7.5 lakhs, this cap has been provided because many organizations have started using this as a tool for saving tax for the employees. So therefore, this cap was provided to say that in excess of 7.5 lakhs, if the employer is going to contribute, then in that case, that will be taxable in the hands of the employees as a perquisite. Then the next one, 17 to 7A, annual accretion on the above contribution, that is the contribution in excess of 7.5 lakhs.
What is the logic of 7.5 lakhs?
I don't know the exact logic of the amount, but maybe they could have taken based on the trends that they had. Because people were contributing at 12% of the entire salary. So the salary might run in crores. So in that case, even if it's taken as a crore, then the contribution will be 12 lakhs. Easily that 12 lakhs is being a deductible expenditure for them. Therefore, they wanted to cap it. Maybe they could have capped it at the normal level at which other employees are taxed. So 17 to 7A is with respect to annual accretion on the above contribution. So here, with respect to this, rule 3B has been introduced recently. And how do you calculate the annual accretion for the purpose of the perquisite taxability in the hands of the employees? So here it says, first thing is we need to determine the interest rate. Interest rate is nothing but the interest that gets credited in the recognized provident fund account. Whatever interest that gets credited divided by the opening balance plus closing balance divided by 2. The average balance in that particular year. That will be the interest rate. That interest rate will be multiplied by the excess contribution. Say for example, if they contribute 12 lakhs, then only the excess portion that will be taxed, say 4.5 lakhs, will be considered here. The excess contribution will be divided by 2. It's just to take it as an average, on an average level. So interest rate will be applied on that excess contribution, plus interest rate will be applied on excess contribution that has got accumulated until date. So it is nothing but during the year, what is the excess contribution that you have made? On that, apply the interest rate, arrive at an interest. Then, until this year, whatever excess contribution that you have already made, then that amount multiplied by the interest rate. So, interest is getting applied even on the previous year's excess contributions alone. So, that is this portion. So, you will add both and then offer it to tax under 17 to 7. This is how this calculation is being arrived at. Moving on to the last clause in section 17 to clause 8, it just says it brings in inclusivity, even an exhaustive definition. It says any other, sorry?
Both interest rates are the same.
Yeah, both interest rates are the same. Interest rate will be calculated as interest amount that gets credited divided by the average balance.
If it exceeds 7.5 lakhs or contribution amount into interest rate?
No. So this is only on this excess contribution. So if your contribution exceeds 7.5 lakhs, on that excess contribution, what is the interest that is available? Only that interest gets taxed as salary, as perquisite.
Let's say it is 8 lakhs. So that 50,000 into interest rate, that interest rate will be taken.
Correct.
In both sides.
It's 50,000 multiplied by the interest rate. Say for example, in a similar manner you have contributed in excess in the last year. For the last year you had 150,000. Then that 50,000 is the second portion. Prior year is 50,000. Likewise, if say for example you have calculated for 2 years, then 1 lakh will be given. 1 lakh multiplied by the interest rate. That will be the
and that interest, along with that they have given earlier interest rate and that interest.
Right.
So that will be double tax. That what is the interest rate into contribution plus
because
interest?
that interest will also be subjected to interest during the current year. See, just think. you have contributed in the past, and there will be annual accretions to that contribution, right? In the current year, how will you calculate the interest that is attributable to that annual excess amount? One is during the year you would have contributed in excess. On that excess contribution you will have an interest, right? And then you would have contributed in excess in the past years. On that contribution there would have been some interest. On that interest also you would have earned interest in this year, right? So it's previous year's excess contribution and the interest which will be subjected to current year's interest. That is how we are.
Thank you.
So I think government is coming up with the calculation itself for these things, right?
Yes. So this calculation is notified.
Notified, right? But they said they will give the statement itself in the form that within 7.5, excess 7.5.
Correct. The statement will be provided. That is yet to get regularized.
Regular, right? Or we need to.
Yes. Now we will not be able to get it from the statement.
Yeah, now we have to calculate.
Correct. We will have to calculate the current interest.
Just to confirm, any accretion up to 7.5 stands exactly.
Stands it.
Correct. There is no purpose. So the last clause, Rule 3, Sub-Rule 7. The first one being interest-free or concessional loan that is made available to employee or member of the household. So if it's going to be a loan, it is given by the employer to the employee, and if it's interest-free or a concessional loan. If the employer is going to get an interest at market rates, there is no purpose. So if they are giving it at an interest as an interest-free loan or at lesser than the market rates, then in that case there is a percentage. And how this percentage will be valued? It's SBI interest rate as on the first day of the previous year in which the loan was given. So it's not every year's interest that gets applied. It's only the interest rate that is fixed as on the first day of the previous year in which the loan was given, multiplied by maximum outstanding monthly balance. Maximum outstanding monthly balance will be calculated. On that you will apply the interest, then you will aggregate that will be interest for the year. Okay, so the first step will be to see the statement. Say for example, you have given a loan to the employee on 1st September 2023. Okay? On 1st September 2023, the loan balance was 50,000. Now that loan is pending, so you will have to recover it on a monthly basis, say 10,000 per month. So during the month, nothing would have happened. It's opening balance 50, 50, 50. Every day, the same balance will appear in your ledger accounts. Right? Say for example, if an interest gets accrued on a monthly basis, and that is the arrangement between you and the employee. Interest gets accrued at the rate of 10%, but the market rate is say 15%. So 10% interest, so 50,000 will be topped up by the interest amount of 10%. Say assume it is something around say 4,000 per month. In that month 4,000 rupees has accrued. So it's 54,000 will be the outstanding monthly balance. In that particular month 54,000 will be the highest balance. On a particular day interest would have got accrued. Okay? So 1st September you have given the loan. Say 30th September interest gets accrued and 50,000 gets increased by 4,000, the balance becomes 54,000. In that case the outstanding monthly balance, which is the highest outstanding monthly balance, is nothing but 54,000 for that month. Again you will start it for the month of October. October starts with 54,000 as a balance. Again every day goes on. Then on 31st October again the linear interest. Then 4,000 gets added, 58,000. Say if it's not going to be 31st October and the employer has the practice of charging interest on 15th of every month, then in that case 15th will be the date. Let's say for example in October the person has paid some 20,000. So it will be 50,000 plus 2 months of interest, assuming 58,000. 58,000 minus 20,000 has been paid, so therefore 38,000. But for the month of October you will see which is the highest outstanding balance. In the month of October, 58,000 would have been the highest balance. During the month, 20,000 would have been paid, but that will not be considered for the purpose evaluation purposes. So it's the highest balance in that month. Highest balance in that month is 58,000. Then when this 20,000 will be factored as part of purpose evaluation, it's only for the next month. So in the month of November, your highest balance would have got reduced by that 20%.
Yeah. SBI interest rate, let's say SBI interest rate is 6% and employer the loan rate is 9%. SBI interest rate is 8%.
No worries. So you are just benchmarking it with the market rates. If the market rate is nothing but the SBI rate, okay? If your market rate is 9% and you are offering at 6%, there is an issue. There is a purpose for that 3%, right? But if the market rate itself is 6%, but if you are offering a loan at 9%, there is no benefit that the employee gets. He is even paying in addition to what he would have paid otherwise. Right? There is no benefit.
The SBI rate means benchmark rate. Or what is the rate?
It's a benchmark rate.
So the difference should be purchasing.
Correct. So you will reduce whatever is required from the employee. Then the next one is traveling, touring, accommodation. The expenditure that is incurred by the employer on behalf of the employee will be taxed. Again, this is only for, say, this is not on official duties. So if it is for official duties, sorry sir?
Pleasure, sir.
So this is not for official duties. If as sir said, if it's a pleasure travel, then it will be taxable as a percent on whatever expenses that is being incurred by the employer. Then the next one, free or concessional foods or beverages. So expenditure incurred by the employer on behalf of the employee, but there are some exceptions that are provided. One, food that is provided during office hours or at the office premises, or if it is, say, the office itself is at a remote location, then the food that is provided over there, that will also be perquisite free. It's not taxable as a perquisite. And the next exception is paid vouchers are given, which are not transferable and usable only at eating joints not exceeding 50 per meal. So here there are a lot of practical questions that are arising. But till now it's not tested by the courts at a very extensive level. But still there are a lot of practical issues which has got arisen because of this. One is, it says paid vouchers which are not transferable, usable only at eating joints. So you would have heard about Sodexo passes. So that was very famous for claiming this particular exception. So those passes were not only usable at eating joints. So what is meant by these eating joints? Eating joints, a few will take a view that eating joints are nothing but restaurants. Where you go, you get some food to eat immediately. And not something like where it's a departmental store where you get dal, go home, cook and then eat. So eating joint is somewhere where you get a prepared food. Whereas Sodexo passes were used even otherwise. So even at departmental stores, at some other joints which may not be considered as an eating joint as such. So in that case, whether this exception will apply or not was a question. So some people take a view that it was intended to provide only for that purpose, therefore this should be exempt. This should be out of the perquisite valuation. But some people strictly say that no, it's not an eating joint, therefore no exception will be provided for those kind of passes. So we'll have to wait and see how this gets tested before courts. This is still open, but there are many interpretations on this. Similarly, on 50 rupee per meal, there are some rulings on this context. So per meal doesn't mean the meal per day. So it's like in a day, it could be 2 or 3 meals that is provided by the employer to the employee, depending on the working hours. Say for example, if an employee is working from 9 a.m. until 9 p.m., then in that case, morning breakfast could be provided by the employer, lunch could be provided by the employer, evening snacks could be provided by the employer. So there are 3 meals which are being provided by the employer to the employee. In that case, it's 50 per meal. So therefore, in a particular day, the exception will be for 150 rupee. It's not 50 per day, it's 50 per meal. So therefore, in that manner we can calculate. That is being provided even in some jurisprudences. So that is being accepted. The next thing is tea and snacks provided during working hours, that is also out of permissive valuation, that is covered as a part of exception. Then moving on, gift, vouchers, token in lieu of such gift. The amount of such gift will be taxable as a perquisite. If you get it up to rupees 4,999, it will not be taxable as a perquisite. But in excess of 4,999, even if you get 5,000, then it will be taxed right from 1 rupee. So that is the manner of calculation for this. The next, credit card expenses, if it's used only for official purposes. Say for example, you pay MCA fees using your credit card, using a corporate credit card. Then in that case, that is only for official purposes, that is not taxable as a perquisite. But if you use your credit card expenses for something else, for say for buying something for your personal use, then in that case, it is a perk, and the amount that is incurred by the employer for that will be taxable as a perquisite in your hands, in the hands of the employees. The next thing, club expenses. If it is for official purposes, again you need to prove that the club expenses that is incurred is only for official purposes. So if you are able to prove that, it's not a perk. But if those club expenses are for personal purposes, then amount incurred will be taxable as perquisite. Now, when you join a club, there will be an initial fee that is payable, and there will be annual membership or subscription fees that is payable. Here, the perquisite covers only the annual membership or subscription fees. It does not cover the initial fee. There is a specific exclusion which is provided in the rule itself, and therefore, to that extent, the benefit is there. And there are exceptions as well. So, if say for example the company, the employer is providing access to some health clubs, sports or similar facilities, in that case there is no perquisite in the hands of the employee.
So what kind of clubs are they speaking?
Sports club.
No. Health.
Say for example
And similar clubs, they have similar facilities.
Say for example there is a yoga center. So it's basically for the well-being of that employee.
No, that is excluded.
That is excluded.
But what is then? What will be the perquisite if health, sports, and similar is?
No, there will be some industry clubs, right? So say for example, if you take leather industry, leather manufacturing industry, in those cases there will be clubs where those industry participants will join. They will speak about the industry, all those things will happen. So that's just a social club. So if you just join that club, then it could be for official purposes at one end, but there could also be personal benefits on the other end. So if it is only for official purposes and if you are able to substantiate it, then you can say there is no perquisite in the hands of the employees. But if you are not able to substantiate it and it also offers some personal benefits to their employees, then in that case, it is a taxable perquisite in the hands of the employees.
But generally they say
No, not generally. There are several clubs. Actually, it will be difficult, practically difficult to fit it under health clubs or sports and similar facilities.
otherwise it will go into official. If it is not going
It should be substantiated, no? There lies the difference. Because you cannot substantiate the social clubs just to say that this will offer only corporate oriented programs. It doesn't offer any personal benefits to the employee. That is something which is difficult to substantiate. Say for example, if you join a social club, then they might offer concessional travels to foreign countries. In that case, the employee is benefiting merely because of the club membership, right? So in that case, it's not for official purpose. He is just enjoying on his personal behalf, not on behalf of the company. The company is not enjoying that. It's only the employee who is enjoying. So it becomes a personal thing. So if you are able to substantiate that it's only for official purposes, there is no benefit like that which the employee gets. In that case, as you said, the perquisite will be nil.
This initial fees is concerned, no? It is for application fees or even they are paying membership fees in the beginning that also is covered?
It's only the application. Only for becoming a member. Once you become a member, then annual membership fees and all is perquisite. Then the next part, use of movable assets. Say for example, the corporates give laptops, computers. In that case, it is nil because that is something which is essential to do their official duty. Therefore, it is nil. There are other movable assets which are being provided. Say for example, mobile phones could be provided. or any other assets. Say for example, journalist office or newspaper's office, they could be provided with a camera. So there are other tools or equipments which they might need. So if those movable assets are being provided by the employer to the employee, then for laptops and computers it is nil. Whereas for other cases it's 10% per annum or actual rent payable by the employer. Now the question arises as to whether this is only for official purposes and why should I pay a purchase tax? So if it is only for official purposes, yes, it's not a use of movable asset by the employee for his own purposes. So if it is going to be, say, usage of a particular movable asset for his personal purposes, then there arises a perquisite and the perquisite needs to be valued in this manner.
Is it mentioned that it is mentioned somewhere that
it's not specifically mentioned in the rule, but still if it is used only for official purposes, no one will pay tax on those things. Say for example, this furniture will be there at office. We are using this furniture, right? We are using this only to be there at office and this only makes us comfortable. This is also correct. This is also, there is no restriction as to whether this will be used at office or at home or not. So if the employer's asset is being used by the employee, then there is a perquisite. So it is meant otherwise to say that if you are using it for official purposes, there is no perquisite. If you are using it for your personal purposes, yes, there is a perquisite. The next one is transfer of movable assets. So some corporates have this practice of transferring used furniture, used laptops to their employees. In that case, this rule would be relevant. So it's the depreciated value of the asset, which will be the value of the perquisite. And what is that depreciated value? It's nothing but the cost less the depreciation. Depreciation will be calculated at the rate of 50% per annum for computers and electronic items, and that will be on WDV basis. And it will be calculated only for completed years. Say for example, in the last year you have used for 11 months and not for that last 1 month. Depreciation will not be allowed for that 11-month period. It will be allowed only for completed years, completed 12 months. The next thing being motor cars. For motor cars, the depreciation rate is 20% and this is also calculated on WDV basis. And the next one being other assets, 10% on SLM. 10% on SLM basis. So this will be taxable as a perquisite in the hands of the employees. Then the last one being any other benefit. So the cost that is incurred by the employer in an arm's length transaction less the recovery from the employee will be taxable as a perquisite. Then there could be mobile phones or telephones that are being provided by the employer to the employee, or they could meet just the recharge expenses that is being incurred by the employee. In that case, whatever expenses that are incurred by the employer in relation to the telephone or mobile phone, those expenses will be excluded from perquisite purview and will not be taxable as a perquisite. But the provision, if you just read through the literal language that is given in the provision, it just says expenses incurred towards telephone or mobile phone. It doesn't say specifically that it's only the recharge expenses. It's only the monthly bills that is being incurred for these telephones or mobile phones that will be taxable as a perquisite or that will be excluded from the perquisite valuation. It doesn't say so. It just says expenses incurred towards. But practically, how we follow? So we will not allocate the telephone's original cost, acquisition cost, or mobile phone's acquisition cost. Even those costs could be reimbursed by the employer to the employee if at all there is an arrangement. So in that case, whether that is covered as a part of this exclusion or not is something which is untested till now. But just going by the language that expenses incurred towards these things, it seems to be allowable expenditure, but still it's an untested and open point.
What about with Wi-Fi?
Sorry?
With Wi-Fi, your telephone will be there, then Wi-Fi also.
Wi-Fi charges will also be on a monthly basis, right? So it's an expenses that is incurred towards that equipment. Say for example, if that equipment will work for the internet purpose only with Wi-Fi, then in that case, Wi-Fi is also an essential component.
So it will not be about the same.
Sorry?
It will be.
It will not be about it.
No, if it is provided along with the telephone and if the telephone will work only with that, then in that case, it will be included as a part of telephone. That's not a separate part as such.
it is an exception, right? Telephone charges and mobile charges, if employer gives, it is not prohibited. So this means if Wi-Fi works with telephone only, then it is not prohibited.
No, you need to say otherwise. If telephone works only with Wi-Fi, then telephone will be the main component. Wi-Fi is just an addition to it. Telephone charges are excluded from the purpose evaluation. Similarly, Wi-Fi charges will also be exempt. If say for example that telephone will work even without Wi-Fi, then Wi-Fi becomes a separate component as such. That is its answer.
Then how can we
No, there is no question. No, the question should be different. Sorry. If Wi-Fi is getting reimbursed in many of the COVID cases, okay, Wi-Fi are reimbursed to employees. It is perquisite.
It's not a purpose.
So no one uses telephone exclusively with the user of Wi-Fi. Right?
See, the way the employer reimbursed was quite different. So in some cases it was purely reimbursement and it was kept out of payroll. So they just claimed with the invoices.
That's the next doubt which we have to ask.
So if it was kept out of payroll, then whether it's a perquisite or not is a big question.
Yeah, so that's the first question. We have to go back to the definition and see whether it is a salary.
Salary, yes.
And then we have to take a value to it. Okay? But in your case, for just clarification, Wi-Fi can be used with any number of devices. Why do I use only with this phone?
Not phone, telephone. Broadband is phone for Deloitte employees if they are work from home.
Yeah.
Only this with Wi-Fi they are giving. They are reimbursing it.
Right. They give a.
They are reimbursing it.
They will give you a dongle and they will reimburse the expenses with that.
No, not dongle. The Wi-Fi set.
There's a small thing. The Airtel.
Yeah, the Wi-Fi set. So, but with that is coming with telephone also. So it is coming at 1,000 rupees, 999. So we can't bifurcate telephone and Wi-Fi. So
if the telephone, that's what I'm saying. So if it gets included as a part of telephone itself and it's not a separate device that you can use with something else, then in that case it's an integral part of telephone, it gets covered.
Then it's not a purpose.
It's not a purpose.
And what is arm's length transaction? Can you explain?
That is for any other benefit. So if it doesn't get covered in any of the criteria that we were seeing till now, and still there is a benefit that's being provided by the employer to employee, then you will just see in a similar transaction how it is valued otherwise. So if that benefit is being given to a third party.
So any benefit given by employer to employee is taxed with this any other.
Yes.
So just moving on to the next doubt basically. Okay. Sorry. So there are companies which take petrol reimbursement. We feel it is very unreasonable. Say 50,000 a month. Okay. So we are saying it is unreasonable and we say that it has to be part of at least salary or perquisite. They say it is reimbursement, so it is not a salary, we have not included as part of salary. So I don't know how to treat it even when we do the internal audit or when we go for tax compliance perspective. No? So this anomaly is always there. So how to treat this?
This reimbursement. Say for example, there is a petrol reimbursement as you said for 15,000. There are two scenarios. One is whether this reimbursement is taken as a part of the CTC for that particular employee,
No.
or whether this reimbursement is being given for performing this official duties, and this is just being given as a reimbursement. And this could have otherwise been incurred by the employer himself, but still the employer is not doing it directly; they are just incurring it through the employee. In that case, the reimbursements cannot be taxed as a perquisite in hands of the employees because it's the performance of, say, the duties of that employee in his office. So that cannot be taxed as a perquisite in the hands of the employees. Whereas on the other case, if it is included as a part of his CTC, and say for example, the employer owns that car and also incurs the petrol expenses, then that motor car valuation which we saw will apply.
Okay, in my scenario, so he is the CEO. Okay, it is structured in such a way that he gets this as reimbursement. Okay, so you understand what I am saying. If it is structured in that way, okay, Okay, you can read maybe HDFC MD's salary which is available in public portal. A lot of things are there. The 2-pager document, he gets 1.5 crore salary. Everything will be there. Okay, in this scenario, he is working in Chennai, he is a CEO. He gets 50,000 rupees car. I say, I say to him, sir, you can only run a 50,000 rupees expense if you are a driver. Okay, and you cannot run with the CEO. CEO doesn't travel for 50,000 rupees. No? So it is structured. Okay, that is where my question is. Okay, tomorrow, see, all of us work for the assessees, okay, or employees. But tomorrow when the question comes, no, they think us as an exclusive person.
Correct. We need to answer. So we need to have some sort of a documentation to substantiate that it's only for official purposes. Then only it will be exempt.
So it is a problem, is what generally rate. So what I am saying, there are some companies which do structuring. Okay, I mean, I clearly use the word called structuring. Okay?
That's why I spoke about that out of payroll, because there are some companies which give reimbursements.
They do
keep it out of payroll.
reimbursement, say uniform allowance, uniform washing allowance. So there is a term washing allowance. They do reimbursement, and then traveling is one reimbursement, petrol reimbursement, and general one reimbursement is there. They generally travel to say department or to somewhere, okay, wherever they go to client place, 25,000 rupees. Somewhere I read if it is reasonable, it is allowed to be as part of, say, fully exempt under the salary perspective. If it is not, then I don't know, so how to treat this, even an IA report or compliance?
Reasonability could be very subjective.
Very subjective.
Because like some courts might accept, some jurisdictional high courts or some jurisdictional high courts might accept, but some members might say like, there is no criteria of reasonability that is being provided under the income tax act provisions, therefore they may not accept. So it's a very subjective position, if at all we are going by that route. So on the other hand, it will be better if we have documents, see, as per the provisions, if the expenses are incurred only for official purposes, say we go to income tax department, we incur some expenses, auto cab charges and we get it reimbursed, that is only for performance of our official duties.
Absolutely.
In that case, we need to maintain a proper documentation, and that's why employers also ask for cab bills, auto bills, and based on that we get reimbursed. So therefore, based on that invoices that we give to them, we will be able to substantiate that it is only for official duties that we have incurred. But if, say for example, we are not able to substantiate that it's for official duties, then there is a risk that it could become a perquisite.
It's always a risk.
There is a risk.
So reimbursement will always be questioned, or it is based on the reasonableness, it will be questioned, right? That's how we have
Reasonableness is a luck that we need to try.
No, see, that's what we have been discussing. See, Wi-Fi, mostly in COVID cases for all IT employees, Wi-Fi is given as a reimbursement. Okay? Say a table and furniture is also provided to them. You can buy and get it reimbursed. Okay? How do I treat this? So basically, an officer can come and say anything is not.
Definitely, there is a risk. But they need to substantiate it by saying that this is for providing a proper facility for them to work.
See, there is a word, anything, any benefit, any amenity, right? That's all.
They could see.
If you just read the lines.
Tax officers will say anything and everything. So even if it's clearly given in the provision, they will interpret it in a very different manner, and then they will become. So it's like, if we are clear in our position, we need to have proper documentation to substantiate it. If we don't have, we will always have the risk of getting lost.
At least you have to say, see, a lot of perquisites, like you said, concessional interest rate. Nobody takes that as a perquisite. Okay, at least they are
I agree with that point, because many of the corporates, they are not even aware of these provisions.
No, one interesting point is rent-free accommodation. We have to pay RCM. We are reporting RCM, but the director says don't pay tax on this. The tax is becoming high. Already I am paying 20 lakhs, you don't include this or go. I don't know what budget. He himself is getting caught. So that kind of interpretation only we can tell them, but they are not understanding still. That's the point.
In that case, all these expenses needs to be grossed up and then paid to them.
Yeah.
Now going to the next slide. But still, we'll just summarize the provisions. Section 22 to 27. Section 22, charging provision for income from house property. Again, this is also an important head of income which we will see in our professional career, because it's like, again, as sir was saying, just like how people are not aware of the perquisite valuation and things like that, people are also not aware of whether to disclose a property or not in their income tax return. There are cases like that. I think you would have seen it. So at least we should give that awareness that they should at least disclose these properties, otherwise they will get caught at some point in time. So some stamp valuation will happen at some point in time, and that gets communicated to the income tax officers. It gets informed in the AAS. Like that, it goes through a route. So before that, it will be better if they become aware that these properties need to be disclosed in the income tax returns, and they do that. So this kind of an awareness, it's also our duty to make them aware. So with that background, so section 22 will be the charging provision for income from house property. It says that annual value of property shall be chargeable to income tax under this head if there is a property and the assessee is the owner of that property, and the property should not be held for the purpose of carrying any business or profession. First thing is, there should be a property. Property should consist of buildings or lands appurtenant to the buildings. The land should be linked to that buildings. It should not be a separate land as such. So therefore, income from vacant lands, parking slots, all these things are not covered under income from house property. It gets taxed as a part of income from other sources. Next one, assessee must be the owner of the property. So ownership could be, say, it could be a legal owner as such, or they could even have leasehold rights, and they could enjoy the rights of the owner in respect of a property. Even those owners are considered. Then the next one, property should not be held for the purpose of carrying on business or profession. If it is held for carrying on business or profession, it will not be taxed under IFOS. They don't say it is altogether exempt. It will not be covered as a part of IFHB. It will be covered as a part of either PGBP or IFOS as the case. Then who is the owner?
What is this as the case may be? How can we say this is IFOS?
If they are going to, if it is going to be linked to the business that they are going to carry on, then it will be PGBP. If it is not something which is linked to the business, if at all that kind of a situation arises, then it's going to be IFOS. But it's an income which is taxable. Owners are, there is a deeming provision which extends the definition of the term owner, and that deeming provision is provided under section 27.
So he has to be the owner.
Correct.
And he is carrying on business or profession. Then how can we charge him to be the mechanism?
No. So, say for example, there is a property and it's being owned by Mr. X. Right? If he lets out that property as a part of his business, he is into renting out business. In that case, it will not be taxed under IFHB. Letting out is his business as such. So he is using that property for the purpose of business or profession. In that case, it will be that rental income which he earns by letting out the property, that is not taxable under IFHB, that is taxable under PGBP.
No, madam, there is a ruling that says whenever property is let out on a rent, it has to be treated only as income from house.
Yes, there are rulings. I'll come to that, sir. There are
unless it's a lodge, anything like that, theatre.
There are contrary rulings on that.
Exempted. Otherwise, everything is categorized as income from house.
Agreed. So there are contrary rulings on that. We will also detail it.
Then when it comes to IFOS, he lets out.
If suppose it is not his business and it also doesn't come under IFHB, then in that case it goes into IFOS. If at all that kind of a scenario exists, I have not seen practically, but still, if at all that kind of a scenario exists, then if not under IFHB and if not under PGBP, it goes to IFOS. Section 27 provides for the definition of a deemed owner. It includes these 6 categories of deemed ownership. The first thing being a property being transferred by a person to his or her spouse, except for adequate consideration or agreement to live apart. So in this case, the person who is the transferor, he will be deemed to be the owner of the house property, because it was considered that he has transferred only for avoiding tax on that property. So if he will still be considered as owner of the property, and the rental income that is received in respect of that property is transferred to his or her spouse, that will be included as a part of the income of the transferor. This is something different from clubbing. Clubbing, no, like we will calculate the income in the hands of the owner, actual owner, then we will club the final income. Here we will not calculate the income in the hands of the spouse. Instead, we will directly calculate the income in the hands of the transferor itself, because transferor itself is considered as a deed loan. The next one, again being a transfer of property by a particular individual to his or her minor child. There is an exception that is provided only for minor married daughter. Next one being holder of impartible estate. So if it's a big property which is indivisible, and in that case, the holder of that estate will be considered to be a deed owner of all the properties that are comprised in that estate, because it's indivisible. Therefore, he is considered to be the owner of all the properties comprised in that estate. Member of cooperative society to whom house property is allocated under a house building scheme of a society or company or association. The whole property will be in the name of the cooperative society or in the name of the association, but each member will be allocated a particular flat or apartment. So for that particular apartment or a flat, that employee will be, that person will be considered as a deed owner.
Holder of apartment or estate,
say for example, A, B, C, D, they are all of the same family, and there is an estate which they have, and it's considered to be indivisible because of some factual reasons. Say for example, it's an inherited property, and the predecessor would have said that no, you should not divide it at any point in time, something like that, and therefore it's an indivisible property. In that case, each of the person will be deemed to be the owner of that property.
Everybody,
four person. Yeah. 4 people will be considered as a deed owner of that property, but again, it's only their share which is going to be taxed in their hands. But they will be considered as a deed owner. They cannot say, no, I am not an owner of the whole property, therefore I cannot be taxed in respect of this income. They cannot escape from that.
They can't do the whole income divided by 4. That will be taxed.
In that case, it could be like that, or they could even agree for the share between those 4. Only in respect of the income. They cannot divide the property, only in respect of the income they could arrive at a mutually agreeable share. Then person in possession of property in part performance of contract under section 53A of Transfer of Property Act. I think you would have known about the conditions that is provided under section 53A. It just says the advance should have been paid and the possession should have been taken, agreement should have been entered into. So in that case, there is a part performance of contract under section 53A of Transfer of Property Act. In that case, the person who is in possession, who has already taken the possession of the property, he will be considered as a owner. The last one being person having rights in a property for a period more than or equal to 12 years, he will also acquire the rights of a deed owner, and therefore whatever rental income or whatever income that arises from the income from the house property, that will be taxed in the hands of the that particular individual. This is a ruling. So this is the facts of a particular ruling. X and Co. I'll just take a few minutes on this and then move on. So there is X and Co. who is the owner of this particular building and who has provided the facilities to the user. So say for example, this X and Co. has built shopping malls or business centers in these premises. So it has different floors, and X Co.'s responsibility is providing security, communication, other services to the users, keep open the business centers, permit the employees of the users free access to the aforesaid services. And X Co. receives a rental income for this, receives some sort of an income from the users. Whether that is taxable under IFSP or not is the question before the court. And what is the user's responsibility? They are not permitted to allow any person to sleep or stay in the building. They are granted permissive user rights. That's it. Only the facilities that are provided in the premises by X and Co. They do not have any tenancy right. They do not have any right or title or interest of any kind in the services or the facilities that are being provided. So they just enjoy the services or the facilities provided by X and Co. as against they enjoying the entire property. So there is a difference between these two, and the service charges are payable by the users and they determined at a fixed rate. So in this case, this was a case of the FH Mall and Retail Management Limited, and it was before Kolkata ITAD. So they looked into the objective of Exco. So they looked into the objective and they said that the objective of X and Co is not to let out the property, it is to provide the facilities to the users. There is a difference. Letting out property will fall into the purview of within the purview of IFHB, whereas providing facilities is not something which falls within the purview of IFHB. It's his business. It's the X and Co's business of providing facilities in a particular property. Therefore, it's their PGBP and not IFHB. This was how it was ruled in this particular fact pattern. We might also come across this kind of a fact pattern in our practical day-to-day practice, because it's like there are how these malls will operate is there will be a property owner. The property owner might they themselves let out each and every floor to a particular person, and that person might again split that into different shops and then ask the other person or some other third party to operate those shops. So there might be 3 or 4 parties involved, one being the actual owner, the other one just taking that property on rent, and the second party being developing that property, putting in some facilities and providing those facilities to the third party. So the first one and the second one, between those parties, they share a relationship of landlord and tenant. In that case, whatever the owner gets will be rental income taxable under IFHB. But the second and third party, that is what is being given here. So here the second and third party do not share the relationship of landlord and a tenant, but it's like just like a service provider and a service beneficiary. So therefore, the second portion will be taxable as PGBP in the hands of the service provider. It will not be taxed as IFHB. And there are a couple of other rulings, as sir was saying. There was this Himachal Pradesh High Court ruling, Blue Resorts Private Limited. If the renting is their business, it was ruled as PGBP and not IFHB. There are a couple of other rulings which said that if you rent out, if you let out a particular property, then it will always be IFHB irrespective of whatever your business is. There are rulings like that. But there are other High Court rulings like this as well, where they go into the object clause of Memorandum of Association. They look into the object clause. If in the object clause it is mentioned that letting out a property is your business, then in that case they decide that it's your business, therefore PGBP. If it's not mentioned therein, then it's taxable as IFHB. So that will, if say for example, if you take this SIRC Realtors Private Limited, here the MOA object clause particularly mentioned that acquiring properties and to earn rental income out of those properties is their business. In that case, it was held as IFHB. PGBP. And then the next one, SNEE Infra Private Limited, here MOA object clause said to provide warehouse and supply chain solutions is their object. But still they let out some property. In that case, it was said that the income is from house property. And this also seems to be a reasonable basis. So if it's going to be your business as such to let out, then in that case it will be reasonable for you to offer it under PGBP and paying the relevant expenses as against it, rather than a very rude provision or an aggressive view to say that whatever income that is earned from the house property will always be IFHB. In that case, you will just get that 30% of standard deduction and the interest expenditure, and that might also not look reasonable from a business person standpoint. Computation, I think we all know this. Gross annual value will be the starting point, less municipal taxes, which is covered in the proviso. Then net annual value will be amended. There will be deductions, which we will see in detail, and then the last one will be income from house property, income or loss. For each and every house property, we need to arrive this. Then we can set off the losses from one house property against the income from the other house property. Then arrive the final IFHB. The the properties are characterized either as self-occupied or let out or deemed to be let out. Self-occupied property is something which you occupy by yourself, or it is not occupied because you are not able to occupy it because of your occupation somewhere else. And maximum self-occupied properties allowed is 2, earlier it was 1, now it is extended to 2. And if suppose you have not occupied a property and it is vacant, and at last on 30th March of the previous year, someone gets in as a tenant. In that case, it becomes a let out property for the whole year. It doesn't become a self-occupied property. So, if it is let out during any part of the previous year or any other benefit that is derived by the owner from that particular property, then it does not become a self-occupied property. It goes back to let out. So, let out, if it is let out for the whole or part of the financial year, it becomes a let out property. So, even if one day you let out a particular property, that will be characterized as a let out property. But self-occupied, you need to occupy it throughout the year, or you need to keep it as a self-occupied property throughout the year. Even if one day you let it out to someone, then it becomes a let out property. Then the next last one being deemed to be let out. If there are more than 2 self-occupied properties, it goes to deemed to be let out. And it is at the option of the taxpayer whether this can change from year on year. Yes, it can change. It is at the option of the taxpayer. Gross annual value, this is determined as per section 23. So for self-occupied property, annual value will be nil. For let out property, gross annual value will be higher of expected rent or an actual rent. Actual rent is something with actual rent receivable. That is the exact word that is used. So even if you don't receive it, you need to include it as an actual rent unless it becomes an unrealized rent. Then the next one is expected rent. Expected rent is again calculated as municipal valuation of fair and whichever is higher, restricted to standard rent. I am not going into detail because that itself takes a long, elongated time, so I am not going into that. Then the next one, if suppose actual rent is lesser than expected rent on account of vacancy, actual rent is considered. Say for example, in our case, say the tenant came into tenancy only on 15th of March. So they would have paid only for the 15-day period. So in that case, the actual rent will be lower than the expected rent. Expected rent will be taken for the 12-month period. Actual rent will be for the 15-day period. So actual rent is lower than the expected rent because the property was occupied only for that period. In that case, there is a benefit, there is a relaxation which is provided which says that on account of vacancy, if the actual rent is lesser, then the actual rent can be considered as a gross annual value. Then at last, deemed to be let out, gross annual value will be equal to expected rent. It's the same as here, but just that actual rent will not be present in deemed to be let out, therefore that is not tax. Then when we spoke about actual rent, we also discussed about unrealized rent. So when can the rent be considered as unrealized and kept out of the purview of gross annual value? So there is a rule which is prescribed here, Rule 4 of income tax rules. It says that unrealized rent can be reduced from actual rent only if all of these 4 conditions are satisfied. One is tenancy is bona fide. The second one is the tenant is not in occupation of the property. He is vacated, or at least some steps have been taken to compel him to vacate, and there needs to be substantiated. That needs to be substantiated with documentation. You need to write letters, or you need to call the police to ask him to expel him out. Something like that should happen. Some sort of a documentation should be there to prove that you have taken steps. The third one, tenant is not in occupation of any other property. The fourth one being all reasonable steps are taken, or even if steps are taken, that will be of no use. That also should be proved. So if you are able to prove it with proper documentation or at least proper facts as such, then the unrealized rent can be reduced from the actual rent. Otherwise, the actual rent receivable, even if you have not received it, you need to pay tax by including it as part of actual income. Unrealized rent we have already seen. The other relaxation that is provided is under subsection 5 of section 23. This is for unsold property. Again, this was brought in during COVID times, which was said that if the property is held as stock in trade, the property or any part of the property is not let during the whole or part of the previous year. So, say for example, real estate developers or say those who build apartments. That case, say there are 100 apartments. 98 apartments would have been sold. 2 apartments would have left behind. So in that case, for those 2 apartments, it will have to be someone's house property, right? So in that case, whether those vacant properties will also be considered as house property of the owner of that property and be considered for income from house property purposes was the question. So even if it exceeds 2, then it will also go for deemed to be rental property and the expected rent will have to be offered for tax. So in that case, there was an issue. So therefore, CBD has relaxed this requirement to say that if you have completed construction, then you have a leeway of 2 years. So from the end of the year in which you got the completion certificate until 2 years, it can be vacant and you will not pay any tax on it. That will not be included as a part of your property list. But in between that, if you get to have some tenant and if you also receive some rental income, that will have to be offered to tax. Proviso to section 23(1), municipal taxes deduction. It will be deductible if it is borne by the owner of the house property. Wherein doesn't mean direct payment by the owner. It can even be paid by the tenant and later be reimbursed by the owner. So, and for self-occupied property, municipal taxes will not be allowed as a deduction. Whereas municipal taxes paid outside India will be allowed as a deduction. There was a ruling on this in the case of R. Venugopala Reddy, Madras High Court ruling. It said that municipal taxes paid outside, it doesn't necessitate that it needs to be paid only in India. So for foreign properties, you will pay municipal taxes only outside India. And therefore, it is also allowed as per this proviso. Deductions, there are only 2 deductions, 24A, 24B. 24A standard deduction, 30%. You need not maintain any sort of documentation to claim this 30% deduction. So this is basically for repairs and it is just to give a relaxation for the assessee from maintaining all sorts of documentation to substantiate the expenditure that they are making. So there is no documentation that is required for standard deduction, which is allowed at 30% of the net annual value. And even if they don't actually incur that expense, they will still get the expense deduction. Interest on capital borrowed, it could be for 2 purposes, one for purchase or construction, the other one for repairs. If it is for purchase or construction, then if it's going to be a self-occupied property, it is capped to 2 lakhs. If it is going to be for a lettable property or deemed to be lettable property, there is no limit. For self-occupied property alone, it is capped to 2 lakhs. So, in every year, whenever the assessee chooses a property to be self-occupied or deemed to be lettable, this will also be one of the considerations which needs to be kept in mind before choosing whether a particular property needs to be treated as self-occupied or lettable. Then one more condition that is included is if suppose a property is being constructed and that needs to be constructed within a period of 3 years. If it exceeds 3 years, then the limit of 2 lakhs will not apply. The limit will get reduced to 30,000. This is for claim of interest expenditure, not for any other purpose. For repairs and renewals, self-occupied, always the limit is 30,000. Deemed to be lettered and lettered, there is no limit. You can claim whatever actual interest expenditure that you can do. And this interest is allowed on accrual basis. This is not something which is allowed on actual payment basis. So even if you don't pay, say for example during COVID times, many of the assessors would have they would not have been able to pay the interest expenditure, but still they would have claimed the interest expenditure as a deduction because it doesn't require the actual payment as such. Pre-construction interest. So during the period of construction, whatever interest that you are paying on the loan, that will also be deductible, but it cannot be taken as a deduction in the year of incurrence. You need to wait, accumulate from the year of completion. From the year of completion of the house property, it can be claimed over a period of 5 years. There is no restriction on lenders as far as 24 is concerned, whereas while claiming the principal amount under section 80C, there are restrictions on lenders. Here there is no restriction on lenders. Say for example, you are paying penal interest, whether that will be allowed. Or say, for example, if you are paying interest because you are not able to pay the construction price or the acquisition price one time. In the second case, yes, it is allowed. In the first case, it is not allowed because it's penal. And you have delayed it for your own reasons. It's not a forced perjury case, so therefore it is not allowed. Whereas if it's an exceptional case, then the allowance could be thought of. A very interesting question again, whether a trust can claim deduction under section 24. There are contrary rulings on this. One view is a trust will be subject to its own code, section 11, 12, 13, and there section 11 requires application of income as a criteria for the income to be exempt in the hands of the charitable trust. So whether section 11 will overrule section 24B claims was the question. So there are two views. One view is 24B deduction cannot be claimed by the trust. Why it cannot be claimed? Because trust will always be governed by 11, 12, 13. They cannot be subjected to 24B. And this position was upheld by two tribunals, Mumbai Tribunal in the case of Nandlal Tolani Charitable Trust, Surat Tribunal in the case of Amal Sar Vibhag Kelvani Mandal. So in these two cases, they said that trusts are always governed by 11, 12, 13. They cannot be subjected to 24B. Whereas there are two other rulings where they said that in 24B there is no specific category that is mentioned. So they didn't say that this is allowable only for individuals, this is allowable only for companies, or they didn't even exclude charitable trusts from their purview. In that case, without express provision in the legislation, 24B should be allowable even for trust. This was the position which was taken by Mumbai Tribunal in two rulings. One Shantaram Bhatt Charitable Trust and Satya Sai Trust. But the Satya Sai Trust, which was the base ruling based on which all these rulings came up, so that was distinguished by the Surat, that was considered and distinguished by the Surat Tribunal saying in Satya Sai Trust they didn't even speak any word about 11, 12, 13. So they didn't consider 11, 12, 13 and therefore they have concluded in that manner. If they consider 11, 12, 13, they will always overrule 24B is what their conclusions. Yes, two contributions. But the later one is this. Later one is an against rule.
Takes a more than 20.
Shantara. And that is also overrated by Surat Tribunal. Because Shantara would have relied on Satya Sai. Satya Sai was overrated by Surat Tribunal. So ultimately, for now, the reasonable position to take is if they have applied it, let them take the exemption. 24B might not be a good case. 25, 25A and 26. 25 just says interest payable outside India will be claimable as a deduction. It will be subjected to 24B if proper taxes are deducted at source. That is the only additional condition that is provided for it to be paid outside India. 25A, unrealized rent. If unrealized rent is recovered later, if we have claimed it as a deduction based on Rule 4 and it is recovered later, then in that case it is taxable. You can claim 24A 20% standard deduction at that point and the assessee need not be the owner at that point. So even if he is not an owner, it will still be taxable in the year of death. Section 26, joint property. This is something which we face practically. So in the case of a joint property, the first point is whether it's a self-occupied property, whether one person can say it's a self-occupied property for him and whether the other person can say for this portion of property it's a letter or deemed to be letter. Can that kind of a characterization be taken? Yes, it can be taken. So the characterization will be seen who are the property owner. So one property owner can say it's self-occupied for him, the other property owner can say it's a deemed to be let out property for him. It's the same house property, but still if it's a joint owner, one co-owner can say it's self-occupied, the other co-owner can say it's deemed to be let out. That is permissible. There are jurisprudences in favor of it. And whereas when it comes to computation of taxable income in those co-owners' hands, in that case, at the house property level you will compute taxable income, then you will split it in the ratio that is agreed between the co-owners. So characterization will happen who are the co-owners, who are the owners, whereas computation will happen at a house property level and then it will be divided for each home. Lastly, one interesting point in this foreign property. So say for example, if it's going to be an Indian property, then it will be taxed in the hands of resident and non-honorary resident. Foreign property also it will be taxed in the hands of resident and non-honorary resident. R but not OR and non-residents, for them income from foreign property will be taxed only if it is received in India. Otherwise it will not be taxed. So with this background, let's see two DTWs which are contrasting. Mostly all other DTWs are worded in a manner similar to India UK. India Greece is a peculiar type. So India Greece DTW says income from immovable property may be taxed only in the territory in which the property is situated. So it says that it may be taxed only in the state and it may not even be taxed on the resident state. That is how one DTW says. If we read through India UK DTW, it says it may be taxed in the contracting site in which a such property is situated. The word that is included here is only. This term plays that significant role to say that here it's taxable only in source state, here it may be taxed source state or resident state in both these states. But this is the language that could normally be found even in the other DTWs. So, about the taxation in the hands of say RNOR or non-resident or even ROR, this one is where it is going to be taxed will be determined even it's only after we read through the DTW. It's not only being determined by the Income Tax Act. Where it is getting taxed is something which we need to determine after reading through DTW. Point number 2. What is the scope of taxation? Say for example, under the income tax domestic laws, under the Income Tax Act, we have the concept of deemed to be network. Whether this is recognized in DTWs is something which we need to see. Say for example, if we read through India UK DTW, India Greece is quite simple. There is no mention about deemed to be network at all. It just says income from immovable property. So it will fall back to Income Tax Act. Again, in Income Tax Act, we will have the concept of income from deemed to be network. Therefore, it's covered. In India UK DTW, if we see the definition, here it says the provisions of paragraph 1 of this article shall apply to income derived from direct use, letting, used in any other form of immovable property. So it specifically says that it should be from direct use, it should be from letting. It doesn't say anything about, it doesn't refer back to Income Tax Act on one hand, or it also doesn't leave it open-ended just as how India Greece DTW specifically speaks about it. So likewise, if there are DTWs which speaks that income from house property can only be in this manner, then in that case, whether deemed to be rental property can claim some sort of a relaxation using DTW is something which we can think of or evaluate, depending upon the provisions of the DTW. So these two are some interesting aspects which we can look through in DTW. And lastly, what are the litigation trends that are going on right now for these two heads of income? One, for salary, I think most of us, most of you all would have known that there were humpty of 133(6) notices which were issued to the employers asking them to confirm whether the actual exemption that is being claimed by the employee in their return of income, whether that matches with the exemption that was claimed before the employer, typically a HRA exemption. So HRA exemption using the documents that the employee provided to the employer. Say for example, if they have claimed at 1.5 lakhs and later the employee has boosted that HRA exemption to say 3 lakhs to their return of income. In that case, there were differences and these differences were flagged. There were 123(6) notices that were given to the employers. So from this, again there were some clarifications as well from the Finance Ministry to say that this will just stop with this, there will not be any assessment notices based on this, something like that. But barring that, what does it indicate? So it indicates that there needs to be proper documentation and there should be some sort of an awareness amongst the employees to claim whatever they can substantiate or for whatever they have proper documentation for. They cannot just like that with some numbers without any backup. That is something which people need to be aware of. One, from the employer's perspective, it's the duty of the employer also to make the employees aware. Second, as professionals, we also have the duty to make people aware. And the third thing is, of course, there needs to be awareness on an overall basis about what are the consequences that people could face. One is from the employee's perspective, they could face some consequences saying they have not produced proper documents. From the employer's perspective, they could face some consequences saying they have not validated the documents that they have got from the employer. So what is the risk that we are facing? That needs to be evaluated seriously going forward. Documentation, and then reimbursement of expenses, what kind of documentation that we have discussed in services. As far as house property is concerned, characterization of income. So whenever we get a house property, first thing is making people aware that they should disclose the properties. Second thing is asking about the details of that property and in what nature are they holding that property and in what nature are they receiving those income from the property, and characterizing it. Because people might not know how to characterize it, whether it needs to be IFHP or PGBP. If we say that you can claim more expenses under PGBP, people will tend to move towards that. But whether it can be offered under PGBP or not is something which we need to think of based on the conditions that required to be satisfied for them. So whether it's PGBP or IFOS or IFHP, that needs to be determined based on the prerequisites. It cannot be just influenced by the amount of deduction that you take. So that needs to be practically taken first to the assessees or the taxpayers. Then there are some documentation related questions which are being sought for during assessment proceedings. So say for example, if we get a loan interest certificate. So in that interest certificate, assessing officers are seeing through whether it's a residential house property or it's a commercial house property. So there are cases where if it's just mentioned as loan, and if it's not mentioned as a housing loan, if it's just mentioned as a commercial loan or a personal loan, assessing officers are disallowing it. By just saying this is not a housing loan and you have not used it for housing, your house acquisition purposes. So with this, we need to think through that, okay, these sort of questions are also being raised by the tax officers, and accordingly the documentation needs to be produced. And DTWA that we already saw. So just to sum up, we are in a particular state and there are a lot of intricacies and nuances, and this is not stop, of course. There will be a lot of interesting surprises that we will get from the Income Tax Act. That is always interesting. And but at the same time, it should not be a negative surprise that we should get. To put it in a positive manner, what and all we can do. Say what sort of documentation that we could build up, what sort of awareness that we could build in. So that role, what role are we playing? That is something which we need to evaluate, and with that thought, I'll conclude my session. Thank you so much for